Thanks, guys. Those of you who actually showed up, nice bonuses today. I have a list of, well, hey, I'm going to get back to papers, second half of class. I have a list of companies that you're going to choose from for your next project, whether it's done in a group of one or two, or I don't know if I set up to three, but one or two is better. Or do it alone, another project, which is due on the 16th. So, of November, yes. If you're doing a group project, well, negotiate. It's just I want to get back before the final is the main thing, so that's why I'm giving you a short deadline. So, more learning. If you look at the statistics, you can't hear because I don't have the tape on, you know. Kind of easy later. Anyway, so don't worry about that, but try to do as good a job as you can. You're going to get to choose the stocks, and then later I'll tell them on tape that they have to give me an email and pick from the list here, but you'll get first dibs on that. You also get to see live Brian Gaines, who I've been lucky enough to be associated with in the last 5 years or so, maybe a little longer. He runs his own firm for the last 3.5 years called Springhouse Capital. They've had gains during a very tough period in the high 30s a year. Does tremendous work. You'll see what it's like to start investigating one thing and then what it leads you to another, and how your knowledge builds over time. It's really fascinating, and you get to see him and ask him questions. And once again, it's Brian Gates from Springhouse Capital. Listen carefully.
Thanks. Okay. So I am going to go through a case study of, I guess it's kind of a case study, of the video rental industry. And I'm going to talk to you about where I kind of started thinking about it and how I thought about it. And it goes back 2 years. Is the mic okay?
Yeah.
Okay, great. Thanks. And please ask questions along the way. It helps if everybody kind of speaks up, because it's pretty interactive, and so it'll go a lot more smoothly. It'll be a lot more fun if people kind of talk up and give their opinions and interrupt me when you're not understanding what I'm saying or what I was thinking. So some of the stuff you have to kind of, you'll know more because things have progressed since this happened. This starts 2 and change years ago, so some more stuff has happened, but just humor me and pretend it was as it was at the time, and so we'll go with that. So I entitle it Making Money in a Dying Industry. I'll start with kind of idea generation and where I kind of start looking for at least what I would call hated stocks, things that people don't like. There's always these kind of things around, and there are some easy places to start. Most of them, some you probably know. You can look at 52-week low lists. You can look at stocks with high short interest. Clearly that's going to be a place where at least some people are betting that things aren't good. I always list this, and I think it's kind of interesting. Some people laugh at Investors Business Daily, but you can go in there, you can look at all the industries that people just don't like, that the momentum is flying out of, and that's also kind of an interesting place to start, because you can see where people aren't, which we know from classwork and I guess just intuition. If people aren't there, it's probably better than if people are there. Spin-offs, which I'm sure you've talked about with Joel. And if you know what areas have distressed debt, well, you know what the credit markets are saying are not necessarily good businesses. So that can also be a really interesting place to start. So within these hated industries, there's industries that are hated, and there's good reasons for them to be hated. There's industries that are going to turn out to be interesting at some point. So you kind of have to go through that. And I tend to group them into 4 different categories, and this isn't science, this is just my view of it. There's something I would say is an unsustainable business. Can anybody think about a business that, any business can work if you price a product high enough or you do certain things, but just on gut, can anybody think about businesses that just weren't made to exist historically? I wouldn't force you to bet on anything right now, but anything in the past. Anybody? Think.com, I'll give you a place to start. Yeah, Patrick?
Maybe sort of the pager business?
Pager business, I would argue, there's a life, there's doctors, there's things like that. I mean, that could fall into one of these categories. Anybody? Yeah.
Things like pets.com.
Yeah. That would be my example. It would be at pets.com. Clearly, if they could charge enough for pet food, they can make money selling pet food on the internet. But we know now, looking back, that well, the shipping costs and all these different reasons say you can't sell pet food on the internet. It doesn't make sense to ship a bag of dog food from California to New York. It just doesn't work, and you're not going to be able to find a price that will support that. So, Cosmo.com would be another example. I don't know if people were familiar with it, but a service that delivered you a pint of ice cream or a candy bar. It just can't make sense to do that. So that would be kind of unsustainable business. Bad balance sheet. I've listed cellular in 2002. This would be something that the business works. It's just a question of it's got way too much debt. So it falls in that hated category. Cellular phones in 2002, when everybody said, well, the business is done. But if you really looked at it, you said, okay, we know people are going to use cellular phones. We know that's going to continue to grow. There's just a huge amount of debt on their balance sheets. So they'll do something to either change the balance sheet or they'll make it through it. And when you get these that get the second bullet point, income debt. If you have fixed income debt, the banks, if you had an entire capital structure that was all fixed income debt, there's no one to take you under. The credit holders can't do anything. The banks can constantly review your performance and they can take you under. So that kind of leads you to the second point, which is it's sort of like an option bet. There are points in time where you're so levered that if the banks get in an ugly situation, they're in a bad mood, they can force you into bankruptcy. If you had a fixed income structure that was all high yield notes, then they can't take you under. Does that sort of make sense to everybody? So it's zero or it's really going to work. A cyclical business, and I think Rich was already in the class, and I would say he's kind of a master at looking at businesses that go through ups and down cycles and finding kind of a normalized spot. Those clearly go through a hated period, and I think he pitched Lear to you, which goes through kind of the auto sectors in a hated period, and that would be an example of a hated industry that's cyclical. And then dying businesses, which I listed: photography, photocopying. Paging would be in that category of a business that it's falling. It's just a question of how long is it going to last? Is it really dead? People talk about faxing would fall in this category as well. Faxing's dying, but faxing is going to be around a long time. It's just a question of how long. I wouldn't want to bet. Yeah.
Sorry.
No.
Don't want to interrupt you.
No, please.
Interstate bakeries, like the whole anti-carb trend, would you put that in the cyclical, or would you make it a fifth category for sort of bad kind of things?
I would put that in misunderstood. Well, I don't know interstate bakeries so well. I would say the Atkins thing falls into fad, and that's probably temporary. And so that would, I don't know where exactly that would fall. That would fall, that's an interesting question. It would fall somewhere between what people think is dying and I would say is just kind of faddish. So probably somewhere in there. So is it really dead? I always talk about record stores or something like that, and people say that everyone's going to be downloading music. Well, if you look at downloading music, people are still buying records. People are actually still buying, CDs, I should say, but people are actually still buying records if you really think about it. So these businesses tend to take a long time to really die. What are the people on the inside doing? And this is just insider buying because they're always going to know a lot more than you. So yeah, it's their livelihood, and sometimes they'll take an inappropriate bet on things, but they're more likely to know more about kind of the dynamics of the business than you are. And this is important, the last one, is where is the cash going? Because if we're analyzing something that we know isn't going to be around forever, it's not a growth story, the cash can be a huge component of your return. If they're kicking off good earnings, and you can look at that and you can say, wow, I get 3 years of $1 and the stock's at 6, well then you're starting from a different place than a growth business, because you're going to get 3 years of cash, and then you can figure out how much is left. So the process of analyzing the dying business. So what I say is that it goes through, you look at everything negative. You can almost just take a sheet and come up with, these are all the reasons why someone doesn't like it. And then you can kind of start to build, well, does that make sense? And then you can work through each individual kind of thesis. And we'll go through this with video rental and I'll show you what I'm talking about. I say, before you try this, people are going to say you're nuts oftentimes in these businesses. And at times, I say, you'll believe you're nuts too. It's really, really tough. You're going to have most people saying, you're crazy, you're wrong. And that's really, really hard. It's really hard to hold strong in the face of everybody telling you you're crazy. And you'll look really dumb when everybody told you were wrong and you were wrong, that happens. But what I will say is you're allowed to change your mind. And I think that comes into play here. And you'll see when I talk about video rental, you don't have to go down dying with this. You can say, I think this is. And then you can see something 9 months later and say, I don't think think that's the way it is. And that's the difference, at least in the public markets, from the private markets. The private equity guys, they can't so much make that choice, and that's why things are a bit different. You're allowed to say, I'm in this, I don't like this. And there's going to be varying degrees of pain depending on if you're at a big fund, you're at a small fund, and how. But if it's your personal account, you can change your mind at any time. So don't get too hard-headed either. Kind of continually analyze the facts. So I start with this. And some of you probably have looked at video rental at certain times. If I ask you what's bad about the video rental industry, anybody have any thoughts? Yeah.
Yeah, new technologies online, so video on demand and all replace.
Right.
People are doing.
Right. Video on demand. Yeah.
High inventory cost.
Yeah. High inventory cost.
Cost compared to competitors you'll have with technology.
Right. Right. I would just group that in technology if the business is changing.
Sorry, help Ryan out, just put out your name tag if you don't have it.
There's some real layups here that I'm sure people know. Just speak up. Yeah.
Declining volumes.
Yeah. I mean, I guess why are they declining though? I would just push you one step further.
They're declining because of alternatives.
Right.
As much as they're on Netflix, things like that.
Right. Netflix. So we've got digital. We've got kind of digital distribution, VOD, Netflix. There's one other big one.
Lower cost of production, people can own it versus renting it.
People can own it versus renting it, right? And that's kind of the big change from what VHS was between what DVD is. You can buy it for $10 sometimes. So if you can buy it for $10 and it costs a couple bucks to rent it, well, what are you going to do? Sometimes you're going to buy it, so that hurts as well. So let's talk about those in a little more detail. So we just talked about the sell-through, which is what I would term the ability to buy it. In the industry, they would say that's sell-through. That's what used to be a rental business, VHS. They used to charge, I don't know if anybody remember, it used to be $80 for VHS. A new movie was $80. Now it's $17 for a DVD. If you go into Walmart, if you go some other places, it's $21, $22. What's interesting about that, and that kind of leads you to a lot of other things, once you do some work and you kind of dug into this, is you realize that the studios charge $17, $18 to Walmart. Walmart sells it for $17, $18. Walmart makes no money on DVDs, which is pretty fascinating when you think about the kind of business. How many people out there can sell a product where their channel of distribution makes no money? So the margin completely goes back to the studio. So it costs the studio $2 or $3 to make a DVD, and they sell a new DVD for $18. The old ones, Animal House, things like that, that's selling for about $10. But they're making $16 on every DVD they sell, because Walmart's doing them a favor, saying, we want to use this to generate traffic, which has ramifications. The studios are pretty lucky. Those guys are counting their dollars, and they're pretty happy about it. And it was a revolutionary change that they said, let's sell DVDs for 18. They used to sell VHS at 80. They just rented. They said, wow, let's try something else. Let's sell them at 17 or 18. And that's what people in Hollywood get credited with brilliance for changing the model and making a fortune for the studios. That trend had been going downwards. You had $18. You had older catalog titles originally selling for $15, $16. Then they got the pricing down to $9 or $10. So if that keeps on going, of course, if you were selling them for $4 versus renting, no one's going to rent. They're going to own. So kind of where does that pricing trend go? The VOD window, video on demand, which people talk about a lot. There's a 45-day window, which is important also to understand for this, is that VOD, the way a movie stays in a theater 3-4 months, then it goes to rental and to sell-through. And then 45 to 90 days later, it goes to the VOD window. So there's a portion of time where you can just rent it or just buy it. I don't know if people ever notice, if you ever play around with your VOD at all, you won't have the same movies as you have in Blockbuster. You'll have movies that aren't going to be there for a bit. And that's kind of important because people like to rent the new movies. That's what they rent. And if you look at Blockbuster, 80% of their business is new release. People just wander around the back wall. That's all they do. They wander around the back wall, and they have it set up that way for a reason, because that's what people rent. And that's kind of important to realize as well, because that 45-day window is actually critical. As much as you could say, well, it's 45 days. 45 days is a big deal. People want to rent what's new. Then I would say additional features. You get your DVD. It's a little bit better than VOD. You have 24 hours to watch it, which is inconvenient. I would say that the technology on a VOD is pretty weak. You end up with a lot of errors. It's not so clean. It's not nearly as clean as a DVD. Netflix, which we talked about, and you could say that was a niche product. Certain people, it was made for a different crowd. People who wanted instant gratification would continue to rent. You can't obviously get it in the mail right away. Everybody's familiar with Netflix, I assume. Digital distribution, which we talked about, watching on your computers, not so great. Time to download the movie relative to the length of the movie. So music, everybody talks about, well, people download music. People download music because you use it a couple hundred, couple thousand, I don't know how many times do people listen to a song. A movie you're going to watch once. And then quality, HD DVD, which is going to roll around probably end of this year, early next year. Once it goes HD, it's going to be more memory to go through. More memory, I should say, to download, and so it could be even harder to download it digitally. Piracy, TiVo, ever-expanding entertainment options, other things that are bad about video rental. What's good about the video rental business? Anybody?
You took off too fast, we don't.
Huh? What'd you say?
You took off the answers too fast.
Right. Yeah, Steve. Stable cash flow, yeah. Coincidentally, number 1 on the list. Anybody else? Things you can think of that, some of it I've already kind of talked about, and so it's kind of repetitive for me to force you back. But any other thoughts? Friday morning, not easy. Anybody? Yeah?
An option on selling games and stuff in stores.
Yeah, what else you can do, right? I think that's a classic kind of, look, it rents videos now, but you have these people rolling through the store, what else can you do with it? I think that's, yeah, Mark.
I don't know if they have the land of their stores, so maybe they are building land.
Arguably, I mean, that'd be worth investigating. That can be an interesting story as they own the land, great real estate kind of value. Okay. I'd say, and this is my thinking at the time, well, the cash flows are good. Actually, they're great, I would argue. Renting videos is a great business because what do? You put up this kind of bare bones store and you throw in some shelves. I mean, take a look at a Blockbuster. You've all been in there. What's in there? It's shelves. That's really all that's in there. Some posters, some shelves, a cash register, a counter at the front. Everything else is inventory. And you can get great returns off just putting up a box, just a store, and just rolling through, and people roll right through, and they know the name, and so the cash flows end up being great. As a result, and that kind of ties into the second one, the returns on the investments are fantastic. If it works, if you have people rolling through there, it costs you a couple $100,000 to open a Blockbuster. You put the inventory in there, maybe another $100,000, and before you know it, you're doing a couple $1,000,000 in annual revenue at a great margin out of this kind of just bare bones box. And if you're wrong, you can shut it down and you can just move those shelves down the street. You pick a bad location, you do something like that. It doesn't take much. You just shut it down. You have your lease, but you can maybe negotiate your way out of the lease, and it's an interesting business from that perspective. The 45-day window, which I talked about, economics of DVD, which is really critical, you can't really emphasize that enough, keeps that 45-day window, is that the studios know that they make a fortune off DVD. And the studios are saying to themselves, well, if we cut this 45-day window where we sell all these DVDs, because much in the same way that everything rents early, everything sells early. When War of the Worlds comes out on DVD, that's going to sell probably 70% of its volume in the first 2 weeks. Because people who are DVD fans, they buy the movie when it comes out. And that's when it's priced cheapest, actually. It's priced at $18 when it starts, and then it goes up through time. So they make a lot of money. And that's one of the most critical assumptions here, is that no one's going to break this 45-day window, because why kill a good thing? People rarely kill good things. And the studios, DVD is now a $22, $23 billion industry. They're making probably $18 or $19 billion of profits off their DVD business. They make more off DVD. I don't know if you guys have seen, the new theatrical release market is an $8 billion market. And the studios only get half of that because they have to split it with AMC or General Cinema or whoever it is. So it's $8 billion there. Rental is $8 billion market as well. But the studios have to split that. They're not making all that money because they're splitting with Blockbuster or whoever. The DVD market, they make $18 billion off of it. They don't split it with anybody. So that's probably one of the greatest, yeah.
I thought the studios, in order to make more profits in selling DVDs, like wouldn't give Blockbuster a discount on buying DVDs like the way they would on VHS, where they would share the revenue from the rental.
They do some rev share. They don't, no, they never, they sell Blockbuster the same price that you would pay at Walmart.
Right, but like with VHS they did. So that's why
with VHS they did.
They don't make any money. They make far less money renting a DVD than renting a VHS tape.
They make far, who, the studio or Blockbuster makes far less money renting a DVD than do a VHS. Yeah, that's true.
So if everything's moving to VHS, then is it still going to be good cash flows if I don't have, can't get access to a cheap product? I mean, the studio would rather sell the DVD to Walmart and get all their margin than sell it to me at Blockbuster.
Oh, right, but they have no choice. They have to sell it to Blockbuster the same way they sell it to Walmart, so they can't pick and choose. So it's actually legal. There's a doctrine that basically you have to, Blockbuster's allowed to buy it just like we're allowed to buy it and rent it. So are you asking, can they shut out
Maybe it used to be a much better business when it was just VHS because it was.
Oh, arguably, yeah. No, I'm not. Yeah, it could have been a better business when it was VHS. But I'm just looking at DVD. It's a good business now, I guess, is how I'm starting. And I actually don't know the facts of when it was VHS. So, but if the studios would love to eliminate Blockbuster. They'd love to eliminate the rental business if they could, because they probably make more on the sell-through business, but they can't. I guess that's kind of ties in there. The more stable than people think, and that we'll talk about because that kind of ties into the former things. Mom and pop's still holding 40% share, which is interesting. You'll see this with a lot of retail businesses. And it's sad because it sounds overly capitalistic, but if the mom and pops are out there, you're probably going to steal share. Most big businesses, big boxes, Home Depot, they've basically taken share from individual proprietors who started their business whenever, and they eventually go out of business when someone comes in and does it better. And video rental is still about half, well, probably 40%, 30-40% mom and pop. So there's still business for Blockbuster to take. There's still weak competitors in respective areas that Blockbuster can still take share, which for a mature industry leaves you some opportunity as well. And then I think Mark, someone had said, what else can we do with the box? Which is interesting. So macro into micro. So I've kind of kept it 10,000 feet, just looking at these real high up trends. The simplest place to look to find all these measures, I should say, I'll just let you read rather than trying to speak. What's the one, some of you have looked at retail businesses, I'm sure. Where would you go for step one to see how is this all rolling into play? I've given you like 10 different factors of all this stuff coming together, and where is the first place you'd go? Anyone who's looked at a retail business? Yeah?
Well, I guess you'd want to analyze it from like a four-wall profitability standpoint, like just basically how much does one store generate?
Ideally, if you could do that, but that's going to leave you too much subject to, if you looked at one store, it's subject to a lot of factors. What's going on in that area? Did someone open up down the street? What would be the one thing, the first place you'd go? Yeah?
Sorry, maybe sales per square foot over time?
That'd be a good measure of profitability, which I guess is sort of what I'm saying, but the easy metric that people talk about all the time. Anyone looked at retail? Yeah?
Same-store sales.
Same-store sales, yeah, which is sales per square foot. Just looking over time, retailers offer you the same-store sales and a nice little number that tells you, here's how the business is doing. Now, it's not that easy because what goes into same-store sales, what things could disrupt same-store sales from being a pure indicator of here's how the business is trending over time? Yeah? Pricing. Pricing, definitely, where they're pricing their product. What, just in kind of day-to-day, if you intuitively think about what affects a business, yeah? Hurricane, right? A hurricane could affect it. Weather is a big deal. You look at same-store sales and you think about it, and the video rental business is heavily weekend-related. There's 12 weekends in a quarter. If I take out one weekend, if everybody's stuck inside because of a hurricane, what does that do? Well, that's 1 out of 12, and that's 8-ish%. And so your comp could theoretically be down 8%, but does it mean the business is getting 8% worse? And we'd probably say, no, it really doesn't. Yeah.
When you look at same-store sales growth, are you looking at it on a quarterly basis, on a weekly basis?
You're looking at it as often as they give it to you, but then you're trying to do this, which is you're trying to parse it for, okay, well, am I overreacting? Is there different stuff? Is there different stuff going on? So there's weather. What would be maybe more particular even to a video store that could affect this?
Bad movie releases.
Yeah, bad movie releases can be awful, right? The best movies drive people to theaters. The worst movies don't. And right now there's a box office slump going on, just speaking current time. And theaters aren't having a good time. If theaters aren't having a good time, well, probably DVDs aren't going to rent as well.
Is there a correlation though, like when there's bad movies actually in the theaters, are there more DVD rentals because people decide to rent something as opposed to going to the theater?
Right, and people,
and then is it a delay thing?
Yeah, you could argue that. Most people end up, and over time, if you look at the numbers, it's kind of bad movies just don't get, people don't want to see bad movies, whether they're on DVD or in the theater. So it doesn't balance out. And in fact, good movies people want to watch twice. So I think all that kind of just balances out as bad versus good movies. Yeah.
Well, micro thing is store construction. If there's basically somebody blocking parking or access to a store for some reason.
Right. And that would be why we talked about, when we talked about one store profitability, we want to see a blend for a company, right? Because if they shut down the road and no one can get there, or you can't get there, then that store is going to look really ugly, which is why we hope we have a large enough sample that we're not kind of looking at something that's just wrong, that it's going to be affected by that factor. This is a subset of kind of people talking about movies would be the type of movie, which is you can't even just look at the box office. If anyone has kids, they know children's movies people tend to buy because kids have a propensity to watch a movie 500 times, which adults don't really do. So, if it's some Disney movie, there's a good chance it won't rent well, but it'll sell really well because everyone's going to buy it. So the box office numbers could look great, but the DVD rental numbers won't look great. So there's a lot of stuff going on within even that number that we can kind of bat around. So now we'll get into a particular idea, which is Hollywood video, which some of you may be familiar with. It's a blockbuster. It's more West Coast oriented, so not as many people on the East Coast know it, but think of a blockbuster. That's exactly what it is. Blockbuster has 5,000 stores. Hollywood Video probably has about 2,000 stores. So a bit smaller, but same kind of thing. And I started looking at this in late 2003, so it'll be almost 2 years ago. And if you're in the business, you just kind of go to sometimes conferences. Well, this could be interesting. Who knows? People have talked about it. I've heard about video rental. So I go to look at Hollywood Video. And a lot of stuff I'm just going to have to feed you some of these facts. And you'll just have to trust me that these were kind of the main things going on at the time. They had a subsidiary, I wouldn't even call it subsidiary, something called Game Crazy, which was they took a Hollywood store and they built almost like an electronics boutique or a GameStop, one of these video game stores right next to it, and they called that Game Crazy. They had the high returns we talked about, and I'll show you that a bit later, but let's just assume that video rental stores, when they work, have amazingly high returns. The mom and pop store representing 40% of the industry, and in this particular case, the CEO, whose name is Mark Wattles, owned 10% of the stock. So he was, fairly, well, you could say he's fairly bullish, you could say he held the stock, who knows, but he owns 10% of the stock. That being, those are the facts. And so this is, I'm showing you as of the end of '03, and so this is when I started looking at it, right around $14. Okay, so now this is January 6, 2004. So the new year starts, and this is what I get. So everybody read this real quick. Can everybody see? If you shift, because there'll be a couple more of these slides, so if you can't see, it's probably worth just moving to a seat where you can. Just kind of nod your heads when everybody's done, so I have a feel for how long it takes to read. Okay. So what's good here? What kind of numbers jump out? The numbers that are important. Yeah, Steve?
They're moving the merchandise mix into merchandise sales as opposed to rentals, and that's where they're getting the same-store sales from?
Yeah, I would say that, well, merchandise sales are in pretty good shape, right, up 14%, and a contribution from merchandise sales. They're shifting a little bit, right, so that's kind of the what else can they do with the box, and that seems to be go okay. Yeah.
They're using cash to pay out that and buy shares.
Yeah, and I would highlight that because we're all talking about how good or how bad this is. Well, these guys have enough spare cash floating around that they're buying back shares, paying back debt. What other numbers are really important here? And what do they kind of say to you? Yeah.
EPS is $1.40, so it's a 9 multiple stock, but it's growing 12% same store sales.
Right. It's games for the fourth quarter. Rental was right. So rental was -2, right? But the same store sales grew 12 because merchandise sales were 14, so that negated. So the same store sales for the fourth quarter increased 12%, right? Because we had good merchandise sales. So I guess so we have a -2 rental comp. We got merchandise sales growing real well, and I don't know, where does this leave you on this? Just gut reaction. How are things?
I think really mixed because the core business is deteriorating.
And how much is it deteriorating?
Well, I mean, 2% is, and I don't know the breakout between merchandise and
Right.
rental, but I would assume rental, it's kind of interesting because I wouldn't have thought the merchandise would be able to shift same-store sales that much.
Right. Well, the margin's much lower on it, so you can have big sales and you can shift it. They have Game Crazy. But what's your overreaction? -2% comp. Let's just talk about the core business. Where does that leave you on the qualitative scale of great, bad? What are you thinking?
Not as bad as I would have thought.
Right. Not as bad as you would think. That's kind of where I was. I wasn't saying, wow, this is great. I wasn't saying this is awful. I was kind of going down 2%. We talked about weather can kick us 10% off, good movies, bad movies, all these different things. When it comes right down to it, everybody's saying this business is awful, and I'm seeing negative 2%. I'm not saying we can do much more with it and you go and dig more, but I'm not running away from a business that's doing $1.40. I know the stock we said was at 13, 14 bucks. I know they're paying down debt. They're buying back stock. CEO owns 10%. And comps are down 2%. And this isn't crisis situation, right? We've seen a lot worse. I wouldn't be running scared from this, that's for sure. And I'd kind of question people who say this business is awful. And that's all. Okay, so now January 29th rolls around, a month later. Sorry. Do the same head nodding trick, so I have a feel. People good? I got right. Okay. So what jumps out for people here? And do the same kind of way we went through the last press release. Yeah.
Revenue margins seem to be improving. I'm just getting to the end of the slow reader, but total revenue grew by 13%, but adjusted net income grew by 16%.
Yeah, that jumps out, right? This still kind of holds the same theory of they're still growing their business, right? For the full year comps, what do we see? We were actually, up 3%, right? So we were down 2 in the fourth quarter. We're up 3 on a historical basis for the whole year. Well, the recent trend was a little bit more negative because we know it was kind of down in the fourth quarter. We know that the whole year wasn't all that bad, right? What else? Is there anything else interesting here? Yeah.
It seems like the growth rate is huge. 319 new stores. Is that a concern? Because oftentimes if you open up a new store your first year, it has a lot of revenue that you kind of trickle down as you reach maturity. So I would definitely look into like the ramifications of very, very high growth rates.
Right. Well, when you open a new store, sometimes you get initially maybe a little more revenue. The stores actually take time to build. So your first year.
Depends on the store. But
Right.
I'm definitely looking into it.
Right. No, that's worth. And I would even go further and say, and that's a great point. They're opening 319 new stores. Dramatic growth, right? That's just amazing growth, actually. But what else is important connected to that growth with the new stores, which start out? Yeah.
Well, they were spending money on development, but they weren't getting full revenues from it yet, so
Right.
their margins were depressed.
And how much? And they lost, right? How much did they lose off those stores? $20 million, right? So we're now looking at numbers that have a division that's growing, doubling year over year, and was actually losing money. And that has interesting ramifications because if I showed you just Game Crazy and I said, here's something which is growing and they doubled their stores, but they lost $20 million, you wouldn't say, well, let's value it off of losing $20 million. You'd say, well, how do the initial stores that open look, right? Or how do the first 200 stores look? And what can I expect for these next 200 or 300 stores? So you'd look at it more forward thinking than just, hey, let's value this off minus 20 million. So that's worth noting. When you have companies which have multiple divisions, you kind of got to look at them differently. You can't just say, okay, they're losing this much money as a whole. You can sometimes break it out. And they're doing a great job here. They're telling you, look, we lost this much money from these, and we're growing it pretty dramatically. So I don't have it. Anybody else have anything that strikes them here? Okay. So now they also give this. This is the same press release. So this is also January 29, 2004. Okay. Sorry, I probably cut that short. People probably need a little more time. But anybody want to talk about, just finish this up, what are the key things here? Yeah.
Key thing that I'm looking at is that they're growing their store base by 10% plus, with same-store sales flat to moderately weaker. So you're looking at revenue gains of high single digits a year, possibly with high returns on capital.
Right, right. He's still opening up 150 stores. So this is now beginning of 2004, and everybody's been telling us this business is dead, and this guy's still saying, I want to open up 10% plus of my store. I want to open up, well, call it right around 10%, 8 to 10%. He wants to grow his store base. His comps are basically doing what? Where is it? Right there. What? -1 to -2% same-store sales for the full year. So where does this leave us again? It leaves us as going, things aren't so bad, or at least they think in their guidance things aren't so bad. They're saying -1 to -2%. I could show you, Abercrombie and Fitch can have up 15, down 15, comps all over the place. He's basically saying flattish for their comps. One other thing on the Game Crazy note, how's Game Crazy doing? At least how do they think it's going to do? Pretty good, right? The 12 to 14%. So Game Crazy growing 12 to 14%, still growing store base, comps of kind of flattish, right? Negative a little bit, but in the grand scheme, what's -1, -2%? That could be a lot of different things. So this is where we are. So that was the end of January, I got that. And so now I'm getting interested because I'm saying, okay, so it's a business that's flattish. He thinks they're going to do $1 plus somewhere in there. And the stock's at 11. We're going to do $1.34 in EPS. Or $1.40 is where they basically were. And the stock's at $11. This could be something that's pretty interesting. Not 100% committed. And so here's, sorry, did I just go backwards? So this is how it looked. And everyone does their spreadsheets their own way, so sorry if it doesn't. So going from the top left, I guess, 60 million shares, stocks at $10, 600 million market cap, cash of 145 million, which I hadn't given you yet, debt of 350. NOL, which on these dying businesses can be helpful. You've got something where he can still shield taxes, so $73 million NOL, EV of 735 million. Roll this all together this is the whole company's return on invested capital. So 41.7%, which is pretty amazing. And that's a whole company. So some of you may have looked at retail businesses. When you look at retail, you've got the whole company, right, doing 41% here. And then you've got the incremental returns from new stores, which roll into that. Obviously, your incremental returns, when you've got your whole infrastructure in place, incremental returns are going to be higher because you've got your headquarters, you've got everything, you're just rolling on a new store. So I'm not even cheating. I'm not saying, oh, here's what a new store looks like. I'm just saying that's the whole company. The whole company seems to have great returns on capital. Where does this leave you? So enterprise value to operating income, enterprise value, that E minus MCX is just that's EBITDA minus maintenance CapEx. How does that look? Yeah, 3.9, 3.6. If you said the business wasn't going anywhere, you'd say, wow, that's the cheapest thing I've seen in a long time, right? 3.9, 3.6. On the income statements, what's interesting there? Going from 02 to 03, or just even on an absolute, just looking at the numbers? Anything striking? Anybody?
Margins and sales are up.
Yeah, margin. We talked about this, and I guess revenues are up. I didn't show you the rental gross margin before, or the operating margin for that matter, but the rental gross margin actually grew a little bit. Merchandise margin grew a little bit. Your operating expenses kicked up, but we also know that G&A and that operating expense, some of that has to do with Game Crazy, right? And your margins didn't fall off much. You're still doing 11.1 margin. You did 12% the year before. And on the bottom line, what the EBITDA actually went up, right? Operating income went up, EBITDA went up year to year. So I'm getting really interested now in this business. So this is kind of where I was at the time, and these are the issues I had. I said, how bad is it? And I'm kind of just summarizing facts you've seen before, but I'm seeing video rental going down 2%, video rental business going down 2%. And actually, some of these numbers are confusing. But basically, what I was seeing at the time was you had video rental not falling off that much. You had Game Crazy losing money, which was interesting. And this is what you see here, the negative 20 million in operating income, but still growing same-store sales 15%. So if he's telling me that the business is going to get better, I'm believing him, right? If you saw a business that was negative 20 in operating income, but same-store sales were flat or negative, you'd kind of go, come on, I don't know if I buy into that. But you see something growing, same-store sales at 15%, so he's probably got a story, a pretty good story if he's telling you, I'll make money there, I promise, I'll make money. You can kind of believe him. He's growing that store base, he's growing this store base, and the video rental all in didn't seem that bad. Yeah?
When you had the numbers up before, one of the statements before didn't say like merchandising grew 14% and rental grew 2% and total growth was 12%.
I think it said rental negative 2, merchandise 14, that was a quarter, yeah.
Even cool, I mean, it seems like merchandising is such a small part of the overall revenue sales. I don't know how it could take a negative 2 up to 12 when it was 14 itself. I mean, it's just a fraction of total sales.
Yeah, it does seem surprising. I don't have the numbers here, but it's direct from their press release, so I'll just buy into it for humor me. Yeah.
I'm curious, I don't know the Game Crazy model, but is it so different from the video model, like that you're worried that they don't actually know what they're doing because it's just a new business? I mean, stores may be growing, but maybe they never become profitable.
Right.
So I think what that is, I think buying the real estate and leasing it, how much more is it possible than a Game Crazy store?
Right. I don't have the returns on capital in Game Crazy. Assume they're probably less than a video store. They're leasing. And on your first question, which is fair, is this is when you look at any business. They're probably not as good as doing video game stores as they are video rental stores. Let's make the assumption that they hired people who at least have done it once or twice in their life and know how to open stores, or that they can hire those people to do it. So they're not so bad at it that we have to assume this is atrocious. They may not be the best video game store people in the world, but they're probably not the worst. And I'm just kind of assuming, okay, they're probably okay at it. And they've probably seen that other people have done it. If you look at a retail concept where it's not brand new, right? Electronics Boutique is out there, GameStop is out there. It's kind of known how to operate a video game store. Maybe not really well, but it's known how to do it. And so I guess my assumption is it's not a new concept. It's not like they're going in trying to do something radically different where I would have that fear. So I kind of just assume they're probably okay at doing it. And whatever the industry trends are, they're probably going to be pretty close to that. Any other questions? Okay. So here's what I came up with. So I did EBITDA of 230. And actually, I didn't give you the CapEx number. I'm just going down the first column. But assume the maintenance CapEx for these stores. They have 2,000 stores. It costs about $10,000 a year, which gets you to $20 million. You've got the Game Crazies. You've got some corporate CapEx. So just assume CapEx is 30. And that's pretty much what it is. I'm not guessing there. You could have gone your work. You could have asked people, and you would have come to a number of about 30 million for maintenance CapEx, not total CapEx. Interest is 25. We had that 300 million of debt. So the free cash flow is 175 million. Tax adjust that, so I'm fully taxing it. Right? So I'm just saying 175 times 60% and dividing it by the number of shares, and I'm getting $1.90. And I'm saying, here's a business that has some good stuff with Game Crazy, has some bad stuff with these overall video rental trends that I'm concerned about. Comps are still flattish, returns are still good. I don't think I'm crazy to take that EPS and say it's worth 8 times that. You could debate it, but not nuts at the time to look at it and say kind of flattish. So that's 15.2. Then in the next year, I'm going to get $1.90 of cash back from what the business is going to generate. And so I get to a total value of $17. This is what I was thinking. 70% on that, right? Stock's at $10. That's pretty good. Then I say, okay, let's hammer it a little bit. And I'll grant you that going from 230 to 225 isn't destruction, but let's hammer it a little bit. Let's say I'm a little bit off on the CapEx. And you can roll through that same kind of analysis, EPS of 70, and then I say, okay, I'm hammering it a little bit, and then I'm also hammering the multiple a bit. So you could argue with me on, well, the business is dying, but I'm not being too generous. I'm giving him an 8, now I'm giving him a 7. Even if I give him a 7, I hammer the numbers a little bit, I still get to 36%. And this is, in the last column, is really fascinating. If you say to yourself, okay, so let's say things are really awful, but this Game Crazy, let's look at it as a separate division. Let's not put a multiple on the same thing. So I add back the Game Crazy losses. Gets me 246. CapEx 30. I actually sell off Game Crazy, so I have less inventory, I have less things to manage, I get cash for Game Crazy. So let's say I tell Electronics Boutique or GameStop, I want out of this business. They say, we'll give you some money for it because we know we'll make it profitable. You want out. You get to add back your losses. You get some credit for selling all this inventory and selling everything off, so your interest expense goes down. You get free cash flow of 196, tax adjust that, EPS of 202. You put a multiple of 8 on that, and now you're staring at something that could make you 80%. So that is, and it, to be honest, could get more complicated, and there's more stuff, and there's more work that gets done. But that kind of sums up what I was thinking. Not rocket science, just kind of, okay, looks like I could do pretty well with this, and I'm probably not going to get killed. So at 10, 11 bucks, I get pretty excited. I think the stock actually probably got into the single digits, and so that's where I was. Now, Hollywood. These are my conclusions, and I didn't really add this, but the CEO owns the stock. So in this, to someone's point about Game Crazy, whatever the right thing to do, he's going to do it, right? He's going to, if he wants to shut it down, he'll shut it down. If it's making money, we'll trust him. He owns enough of the company. He owns a lot more than we do. So put some trust in him that he's going to do the right thing for his own pocket, which is the easiest thing to trust. Margin of safety from backing out the Game Crazy losses, the NOL, the inventory, and bare level of maintenance CapEx. If things go really ugly, what are these guys going to do? Let's say video same-store sales were down 20%. What are they going to do? What's one thing they can do to start cutting costs? They can let their stores start to look really, really bad, right? They can stop putting any money into the stores. They can save more money that way. They can say, you know what, if people aren't going there, they're not going to care so much if the store has, XYZ number of tiles or a number of tiles not in the bottom. The cash registers look like crap. Everything in the store just starts to look really, really poor. And you've seen this with Kmart, right? What does Kmart look like? Kmart gets worse. As Kmart got worse, if you've ever been in a Kmart and you saw what it looked like 10 years ago versus what it looks like, they let it go to crap, to be perfectly honest. And that's kind of step one. If you think the business is dying, well, don't put any more money into it. So I knew, okay, if things get worse, he'll stop putting money into it, so that'll help me on the downside as well. So I kind of look at my upside and I say I could do really well. And if things go bad, there's probably some mitigating things that'll help me recoup my money and not lose money. And then everything we talked about in terms of, well, the business isn't really that bad. So that was kind of step one. And then this is March 29th. Everybody get through? Yeah. What sticks out? What are the important things? And beyond, obviously, okay, 14 bucks, you're happy, right? But what else is important here? Yeah.
He's still sticking with the business.
Yeah. What's the CEO doing? He's saying, I want to hang around. I'm not selling my stock. But beyond that, what's he saying? He's even making a more forceful statement. He's saying, yeah, he's doubling down. He's doing the, you've got an 11 against whatever it is in blackjack against a 6, and you're saying, I'll take that all day. I'll double my position. So he's rolling his equity back into the business. They're levering it up even more, and he's going to own 50% of it now. So going from 10% to 50%, he's saying this is great, right? This is the best thing I've seen in a while, and he's getting excited. Some people would say you got Leonard Green coming in. Some would say they're smart buyers. Who knows? But the biggest fact here is, the most important fact I would say is exactly that, is the CEO's hanging around, you just got 14 bucks. So you're happy, but you also know that the guy who knows the business better than you is saying, I like it even more than I told you before, right? Because now I'm going to roll into 14 bucks. So you're pretty psyched there, right? Because you got lucky in a couple months. So you've done all this work, yeah?
Aren't you upset because you think it's a $17 stock and you're buying it for 14?
Yeah, well, yeah, and that's a twofold question. Yeah, I was upset because I thought it was worth much more, but you're getting 14 bucks right away, so you're not going to go too crazy. And is that a fight worth fighting? And who knows? But yeah, you're a little upset because you think it's worth more. And in fact, at the time, I was saying this is ridiculous. I'm only getting 14 bucks. But you're doing kind of the tongue-in-cheek, this is ridiculous, right? Because you're also sitting there up 30, 40% in 2 months, so you're not crying too much. But yeah, at the time, you probably would have said that. And maybe your hope would be someone would show up with a bigger position and more incentive than you to really try to do something about it. And they'd say, this is nuts. This guy is taking the whole company. He's getting a great deal. So yeah, I think that's a good point. So now you've done all this work, and you don't want to let it go to waste, right? So you say, okay, well, what else can I do with this? Because I know CEO just bought 50% of the company effectively. He doubled down. I kind of like the business. Maybe I just got robbed. Maybe the thing's worth 17 is only worth 14. And so check out the other companies in the industry. The most logical thing to do is, where else can I make money because I've done all this work, and where else can I go? So applying the Hollywood takeout multiple, where I noted the CEO's buying his own business, to Movie Gallery, which Movie Gallery is it's not like Blockbuster or Hollywood in that it's mostly in rural areas of the country. So it'll be in a town of 20,000, there'll be one movie gallery, and there won't be competition. So arguably a better business, and also not subject to all the things we talked about, piracy, video on demand, maybe a little bit less so because it's out in the middle of nowhere, so you're not as worried on certain of those things. So intuitively, I'm just interested in Movie Gallery at this point. So here's Movie Gallery, and funny thing is, I said it implied a $20 stock price. Not coincidentally, it's at a $20 stock price. But I also know that I think maybe Movie Gallery is a better business than Hollywood. So I'm still interested. So here I gave you a little introduction. Movie Gallery, the rural version of Hollywood and Blockbuster. PBI is Blockbuster's ticker. They don't compete as much. Similar high returns on the new stores. Comps are stable. Rural nature of the stores. And here the CEO owns 15% of the stock. So it's like going from one good situation to another. In Movie Gallery's case, unlike Hollywood, Movie Gallery had no debt. So it's all cash. And if a company is all cash versus a company that has more debt on it, well, there's more things that Movie Gallery can do with the cash than maybe the indebted version of the Hollywood. If Movie Gallery were indebted, it'd be much less interesting. Here they could do some type of recap on the capital structure. So that's Movie Gallery. Yeah?
How do you look at cash differently in businesses like this where there is, well, actually, I don't know how much they will grow, but at least
Assume they're growing,
yeah,
let's say 15% a year.
That you're worried that they'll do, they'll waste the cash, as opposed to another business that there really isn't anything else to do with the cash, but potentially, give it back to the guy. I'm looking at the cashes. If they can still get those returns, they can open those stores all day. Yeah. And so that was my attitude, is I wasn't demanding the cash come back to me. I was hoping maybe in Movie Gallery's case, they'd maybe buy back stock because they had some extra cash to the extent the business generated enough cash to open the stores. And this all goes back to, if the guy owns 15% of the stock, I'll assume he's doing what's best for himself, which is the best thing we can rely on. Yeah, if I told you the CEO owns no stock, you'd be a lot more concerned about that, because you'd say, well, there's a good chance he just wants to open stores just because he likes opening stores, and no one wants to be CEO of a business that's dying. They'd rather be the CEO of a business that's growing. And that's why in these cases the insider buying is important, because to that point, it's a concern.
Don't you sometimes have founders that are completely irrational and in love with their business?
Yeah.
Versus actually concerned with their economic stake in the business?
Yeah, and
did you actually...
You meet with them, and you can read. People talk all the time about somebody's irrational. It's a small percentage of people who are truly just irrational, and they don't think about their pocketbook or their wallet at the end of the day. It really is. Sometimes they're not the smartest people on earth, so maybe their decisions aren't great, but they're probably still thinking about how much money could this make me. It's amazing what money does to drive people in the right directions. But yeah, there are those ones who are just lunatics, but the lunatics really, they show, right? When you get some crazy quotes, you get some things that are just nuts. So, but there is that. You could find somebody who's nuts. Yeah.
If I remember correctly, wasn't Movie Gallery one of the potential bidders for Hollywood at the time?
And we're not even there yet. So, yeah. But this is, just assume that hasn't happened yet. So here's the movie financials at the time. So this is now trailing 12 months. That's my TTM from March 31st, 04. And this is the capital structure over there. No debt, $607 million. The multiples are a bit better than, higher, however you view better. They're a little bit higher than they were at Hollywood. Now we're trading 6.5 times operating income. But the forward, this business is growing a bit more, because their returns are still really good and they have more growth opportunities than Hollywood does. So forward operating income was 5.7 times. Similar side on the operating income. So I talked a lot about how great the return on capital is. And here's their investment, $126,000, and you make $45,000 in your first year off that. And then it matures, so it gets even better. And then you make $79,000 the next, well, mature is probably 3 years out in this situation. So, I don't know, is that worthwhile? If you could do that, you do that a lot, right? So assuming these numbers are right, and there's assumptions there, and it's not necessarily true, but assuming the investment stays at $126,000 and the four-wall operating profit is going to be $79,000, you'd probably do that all day, even off year one. So, and this is kind of interesting to think about, which is we talk about how quickly the business is dying, but in this situation, if you make $45,000 back your first year and it costs you $126,000, you go 3 years like that, you're done. You've made your money back, and then everything else is upside. So even if the business is dying, the returns are good enough that in a couple years you can make back a lot of the money, and you don't have to worry about, well, what happens 3 years down the line. 3 years down the line, as long as there's something left, as long as 3 years down the line I'm doing $15,000 out of this store, I'm still happy, right? I'm still probably doing 13%, which for a business where you're paying 5-6 times operating income, you're not so upset with. If that's the situation 3 years down the line, you've probably still done okay. So I guess that's one of the important concepts of this whole video rental thing, is that you make a lot of money back really quickly. So even if it is dying, it's years away. Do we have any questions on that? Okay. So more news. August 6th, 2004. Remind you where I left it was movie galleries interesting. It was at $20. And now we see this. So what do you focus on here? So beyond being, if you're in Hollywood, you're not happy right now, which fortunately I wasn't, but sometimes that's just luck. But all the ARBs, all the merger ARB guys who are in this are not particularly happy because they own something at where 13.5 maybe, that's dropping to, I don't know, who knows, right?
Isn't that a lot of ways just like a way for the private equity group to get out when it doesn't like what it sees? So doesn't it kind of also give that bad signal?
Right, and so what are the views you could have? You could say that, which is Leonard Green wants out because the business is awful. You could say what they're telling you. Maybe it's truth, right? Maybe the financing conditions, they couldn't get as much leverage on the business. The banking market's in bad shape, right? There's that option. So it's kind of two different ways to look at it, and there's nothing conclusive here. It's, they want out, you're not sure why, you'd love to talk to them and say, why do you want out? Did you see some numbers in the business? You're probably not going to be able to get a good answer on that because they're probably not talking to anybody. Hollywood's not going to tell you why. So you're left not knowing. But we know they wanted out. So there's Hollywood. Right, which not surprisingly, is exactly what you said. It drops back to, where was it before the merger? It was at 1050. Now you're saying, I think the business could be worse. So it's arguably worse than it was before the deal got done. Somebody out there could also say, hold on, but Leonard Green's out there. We know they wanted the business 4 months ago. They're saying it's the financing conditions. Maybe that's BS. Maybe it's not. But there are people out there who would also say this is even more interesting now because we know there's a buyer. We know that Waddles wants to roll into a new company probably because he thought that was a good idea. So there's a lot of interesting kind of things that can go on here. But the stock's back to $10. Movie Gallery, even more interesting, is trading down to $16.50. Right? And so this is a couple things going on here. There's some people saying, now the video rental business is awful because Leonard Green wants it out. What I'm saying is, this is even, Leonard Green was this leverage structure that was trying to get a lot of debt onto it. Movie Gallery, probably not affected by all the same trends that Hollywood is. Movie Gallery, a great capital structure. So you've all looked at, if you look at a business that has a lot of cash versus a lot of debt, if the stock drops on the one with a lot of cash, the enterprise value has gone down a lot more, right, as a percentage. Is that right? If you have a lot of cash. So I'm really intrigued by Movie Gallery now at $17. Hollywood, I'm kind of saying, I don't know. I'm where you are. I'm saying, who knows, right? Blockbuster over here. And that's not drop, I should note, that's a dividend. Viacom used to own Blockbuster, they spun it off. So that big drop you see in Blockbuster is just paying a special dividend. So still not a great chart, you're still not psyched to be in Blockbuster. $5 dividend, yeah. So that's just an adjustment, you got that cash. So Blockbuster's still not too exciting. And this is Blockbuster, we just talked about it. So you've got a newly independent Blockbuster out there, right? $1 billion of debt. Viacom kicks them out, says later, right? This looks probably really interesting. If you told me, give me different stories, and you said, spin off from Viacom on a business that's crap, where Hollywood just had a merger breakup, and you'd say, wow, there's a lot of stuff going on here. And this is not, obviously, we know where I started looking at this. This isn't by planning, stuff just kind of happens this way. And if you do any kind of work on something over a long period of time, there's going to be stuff that occasionally just shows up. And you don't know when it's going to show up, you don't know how, you just know stuff will show up. It just kind of happens. Okay, so Hollywood and movie are down, right? The movie capital structure, which you talked about, which is all cash, not debt-laden. Is Movie Gallery affected by what Leonard Green did by dropping Hollywood? The business is worse, maybe, right? If Hollywood's really had tough times, and maybe the business is worse. But I'm getting quarterly comps from Movie Gallery. So they're telling me how the business is doing. And let's just say I know things aren't materially off. So unless Leonard Green's done some amazing work that they figured out that actually, I don't know, digital distribution is going to happen in 3 months as opposed to 6 years or something not so like that, it's probably just Leonard Green getting cold feet and maybe not getting the exact financing conditions they wanted. Got Blockbuster around. Netflix, which would be a whole nother too much time presentation, but Netflix is hanging around as well, which I really got interested in, but it just requires, we don't really have the time to go through what I was thinking on Netflix at the time. But Netflix at the time was trading $600 million, probably a $400 million enterprise value. And Netflix was pretty interesting for a variety of other reasons. But I guess the significance here is just you have all these different places to make money when you've done the work. And that's why I list that. And then to someone's point, when we talked about it, Leonard Green shows up again on October 14th, and they say, well, we'll do it for $10.25. So that's the other thing is Leonard Green may be thinking if we can retrade this deal, if we can do it at $10.25 versus $14, yeah, we'll do that all day. And also worth noting when you think about mergers is what's the CEO of Hollywood thinking about 14 versus 10.25? Pissed? Anyway.
He's buying.
Right, he's buying. So he's happy. He's actually, it's kind of the inverse thought. He's buying in at 10.25 as opposed to buying at 14 because he's contributing to the debt load that's being taken to take in everyone else's shares. So he doesn't care. In fact, I shouldn't even say he doesn't care. He's excited now. He's thinking, wow, this is great. Before I was going to buy it at 14. Now we can get away buying it at 10.25, right? He's pretty happy on October 14th. On 11/11, wow, I double counted that. November 11th, Blockbuster shows up, and they'll say, we'll buy it at 11.50. And this is kind of the newly independent Blockbuster, which is very subtle. Is Blockbuster used to be controlled by Viacom. Viacom, Sumner Redstone and Viacom didn't want anything to do with it. Blockbuster wasn't going to be buying anything at that point. But now Blockbuster's independent, CEO with a huge ego, and he's coming in. And somebody pointed out, movie shows up to acquire it at $13.25. So you would have done well owning Hollywood. And there's a lot of stuff going on here. Then it gets even more interesting. Ex-CEO, so who's now the ex-Hollywood CEO, that guy we're talking about, he comes out, he wants to still buy half the Hollywood stores, right? So he's still hanging around. He's still saying, I really like this. At the time, I was thinking on movie. Okay, so if movie does this acquisition, I was always talking about the capital structure. They buy Hollywood. There's a chance that Movie Gallery is doing $3.50 in EPS post the Hollywood acquisition. And just assume that my math is right. Make an all-cash bid. They lever up. And I'm really excited about Movie Gallery at this point because Movie Gallery is trading at 20. I think they can do $3.50 in EPS. I know without fail that $3.50 in EPS, I'll get at least 8 on that, and I'll get 28 bucks. So I'm psyched on Movie Gallery. I'm buying Movie Gallery. Okay. So here's Movie at 18. You know they're about to buy the. I gave you December 04, so I'm actually backdating that a bit. So Movie Gallery buys, this is now the end of, this is now the end of 04. So this happened, did I give you dates on this stuff? This is August 6th. They showed up again, November 11th, and so here's Movie Gallery at 18. Here is Blockbuster in December of that year. And then it all changes. So now I bought Movie Gallery, and I'm all psyched about Movie Gallery. And this is December 14th, 2004. And some of you have seen this. You may not have to read the whole thing, but just skim it. Get to the important quotes. There actually aren't many important quotes, but it's funny to just look back. Okay, so you've all seen the ads because they spent $100 million to make sure you all see the ads. So what do you know, he's dropping late fees, right? And how does this sound as your first reaction to it, as a consumer and then as someone who owns Blockbuster? Yeah.
Consumer, it's great, but someone who owns Blockbuster, I think that's probably where they get most of their revenue from, right?
Yeah, and we'll see, and I'll pull the numbers for you on what kind of revenue they get from it. I wouldn't say most, but they definitely get good money from late fees. Yeah.
If you're going with the selling business thesis, this is sort of a last gasp of air. You could read something like this.
Last gasp of air. Yeah. Any other thoughts?
I thought it was kind of silly because they charge you a restocking fee, and if that's not a late fee, what is that?
Right. People aren't stupid, right? They know if you rent it, you got to bring it back, and they're going to get you to bring it back, right? I agree.
Or they charge you for the movie, which is probably more than you would have bought if you bought it
Right.
at Walmart.
Right. Yeah.
Well, one of the reasons for Netflix being around was no late fees, so I would expect Netflix stock to go down. It would basically be changing.
Possibly. Yeah. Right. Then now you've got Netflix is pitching no late fees, and we could get into Netflix more. I would argue back that.
At least in the short term.
Right. In the short term. Yeah, that's fair. My reaction beyond just what you all said is it just seemed kind of stupid, is you got a dying business, maybe last gasp, it just seems dumb to give away money. People are paying the late fees. Do people like late fees? No, but they were paying them, right? That's cash. And in an example where I was talking about earlier on, where I was saying we got to account for the current cash, I don't want to be betting on Johnny Antioco, the CEO of Blockbuster, being able to completely remake the video rental business. I want to bet on cash that's coming in today, and that was a huge part of my return. So on December 14th, I'm pretty nervous. Yeah.
Does that end up though, like, because they're charging you for the movie, they're actually going to have you buy it essentially, which
Right.
is a lot more than actually just paying rental fees, I would imagine.
But they're not going to make, but they're going to have you buy something which they're going to charge you retail costs, but they're not going to make money. Assume they're not going to make money off selling it when they force you to buy it, because it's a movie that basically had no value at that point. Or they'll charge you the value of it depending on how much they've rented it. Remember, they take a movie and they pay $17 for it. You're number one guy on the list to rent it, and you rent it once and you hold it for 2 months, and then they charge you $17. How'd they do? They paid $17 for it.
Right.
They charge you $17 for it, and all they made in the meantime was $4 for.
Does it change their working capital though? I mean, does cash come in a lot sooner, and so there's less working capital?
No, because they don't charge you till the end, and they give you all the options to return it to them. They make no money. Because think about the math. If
I know they make
yeah.
cash. I was wondering if it sort of just changed their balance sheet a bit.
Yeah, and it changes their balance sheet in that they need more inventory, and we can get into that, and we'll actually talk about that, and that's kind of one thing to focus on. And attached to this is this from Blockbuster. And in 2004, just so you know, so it makes some sense, they did call it $300 million in operating income. Excuse me. So what? Let's just talk about this one, because this one's the fun one on Blockbuster. Is they're doing $300 million in operating income, and what are they telling you? And I'll give you the number. They actually did about $600 million in late fees. What are they doing by removing these late fees? And they're telling you up front. They're not lying. I would argue they are actually lying to you. But what are they even if you just read this, and I told you they did $300 million in operating income last year, now what's your reaction to getting rid of late fees? It's nuts, right?
Good tax shield.
Yeah, right, it's a tax shield. And how are they telling you, and just what's your intuition on this? They're ending late fees, and they're telling you we're going to give up all our operating income. We're going to make $300 million. Now we're only going to make 0, maybe. But we're going to offset it, okay, by growth in revenues resulting from increased store traffic. So all those people who now run back to Blockbuster because there's no late fees, right? Less promotional and marketing activity, which is crazy because we all know how much you're spending to tell you all there's late fees, but then they're not going to have to promote as much. That just seemed nuts. An increased focus on operating expense management, which is funny when you talk about a company that's been around forever, that suddenly they're going to find a way to cut costs. Because we've all walked in Blockbuster and they're clearly pampering you, right? So there's a lot of cost to cut there. So this just looks nuts. And just by way of background, I don't short stocks, but this just looks like, wow, this is crazy. But I own Movie Gallery, so I'm concerned. And on this one, I'm saying, what does this do to the industry? And I'm not so psyched about that. And then I'm looking at this and saying, this is nuts because how many more people are going to rent movies? And maybe you're going to go in there and you're going to say, okay, I'll rent an extra movie because there's no late fees. But what does that do? That just, now you have the movies for 30 days, so you don't go back that second time to rent the movie you would have rented 15 days from them. I mean, do people really rent more movies because there's no late fees? I'm not going to argue this. If you cut costs, if you cut price, people will rent a little bit more because maybe they think it's costing them less. But you're not even cutting price. You're cutting the late fees, which is something that people irrationally never thought they were going to pay, but we all know that some people end up paying them. So it's just crazy. Just seem nuts. And if that didn't hurt, so that was December 14th, and Netflix charges at the time, wow, this is December, Netflix was charging $18 a month for their service. And this is December 14th, and Antioco decided that he'd add to the fun. So now he's going to charge $15 for his online. Now this is, in my mind, even more crazy. Here's a guy who owns the biggest video store in the country and runs the biggest video store in the country, and he's going to price his online product at $15 when the only other guy out there is saying, we'll charge 18, but he's going to say, no, I'll charge 15. On a business where he's not making money, just so you know. He's losing a ton of money at $15. It's just really, really nuts. So now he falls in the category of nuts. Somebody asked before about what do you do if somebody's just like lost it? And on the surface, this guy has really lost it. This is a guy who's like, I don't know, drunk at 3 a.m. running around some fraternity house yelling like, I am king, right? In my opinion. Okay, and so you do some work, okay? And I wrote everything on the side because people always say, well, how did you know? What kind of math did you do? And so I'll go through what I did, and everything you can see on the right column I listed where I got it from and kind of the math I did. So I took Blockbuster's rental revenues from 2004, and I took a guess. I said they charge $350, not a hard guess. You can call 10 Blockbusters and get the average price. Divide that row by the other row, and you get the number of movies Blockbuster rented in a given year. So they rented about 1.1 billion movies. A lot of movies, actually. The BBI late fees, and this is from their 10K, they told you. And mind you, go back to what we talked before. He told us 250 to 300 is what they're losing in operating income. There's something really weird here when he's telling you the late fees are 600 million, but he's only going to lose 300 million when, I don't know if that flies either, right? How do you give up 600 million in revenue? You really only lost 250 to 300. And these are all public facts. Like this is not, some Inspector Clouseau, I'm going crazy, right? This is all right in your face. Late fees per movie, and that's just his late fees that they gave me in the 10K divided by the number of movies rented, and you got to do the intuitive test here. Does this make sense? And yeah, that makes sense to me that on average, everybody's $350 rental turns into $4 on average, because 1 out of 6 people, let's say, doesn't return it on time. When you don't return it on time, they charge you for another 3 days. Okay, so you got late fees per movie. He told us the hypothetical loss was $275, which just seems nuts. So his late fees per movie, which is just 275 divided by our calculated movies rented per year, he's saying it's only 25 cents, which doesn't seem right, but we'll just humor it. Their cost of goods sold from the 10K, 1.2 billion, and then I just divided that, right, and I got 1.15. And so this still all passes the intuitive test. Blockbuster, simplistically, it costs them 1.15 to rent a movie for 3 days on average. They make $350. It's a good business, right? The extra 3-day sets, okay, so this is just the late fees divided by 350. That's the number of late fees that were recorded. That's just 177 million times they got late fees. And then the average rental length, which is just 3 days plus 3 times, taking that 177.8 divided by the total number of rentals. So now the math really kind of works. It's just 3.5 days is the average rental length. So on average, people at Blockbuster in 2004 kept a movie for 3.5 days. They were supposed to return it after 3 days. On average, 1 out of 6 people basically incurred a late fee. And so I just summarized those key facts below. And it all seems to pass the intuitive test, and nothing seems crazy. Yeah?
Does it seem crazy, though, that you only lose $275? Because if it's late, the movie's not there to be rented by someone else, and it's probably like a 2-day rental perhaps, and so they might not be losing anything by giving a late fees if you assume every single movie.
They may not be losing.
Late was automatically rented by, could be rented by someone else.
And that's the key, right? Well, yeah, I wouldn't say they're not losing anything. And actually, on the next.
That's true, but I mean.
And here's okay. So let's look at it. So we said in the old situation, rentals were $3.50, late fees 57 cents. Costs them $1.15. Gross profit is $2.92. Really, really good, right? 71% margin. Okay, Blockbuster's version of the world. Middle column. Rental $3.50. Late fees are now 0 per movie. Is this still costs $1.15 to rent it, and now they make $2.35 because they gave up the late fees. So margin profitability is down 20%. Now I'm nervous for my movie gallery investment because would you ever want to be in a business that's dying where somebody cuts price 20%? And most people would say no way, right? That's really, really dangerous. So I'm already worried, okay? But even a further level, my version of what happens. And you kind of need some background. Blockbuster, their claim on their late fee test was what they did was they went into a couple markets and they tested their late fees and transactions went up and everything's great. And that's where we came up with our model. What they didn't do, and this is bizarre, is they didn't really, what they thought was they thought everybody would continue to rent a movie for 3.5 days, right? And as crazy as it seemed, that's what they thought, which maybe made sense at the time. Okay, so we'll cut late fees because we went into Peoria, Illinois, we tested this out, and we told people there are no late fees, and they still rented the movies. 1 out of 6 people still decided not to return the movie on time, and when they came back, we said, hey, guess what, no late fees, and that person left with a smile, and then they returned, and they probably rented some more, and so that's what Blockbuster decided. If you think about it, what happens if you cut late fees? How do people behave? If you hand me a movie, I always return my movies on time. I'm very punctual about that. I don't want the late fees. I can't stand Blockbuster. I want them to make the money. If you tell me you're not going to charge me a late fee, what am I going to do? And aside from the fact I dislike Blockbuster and I'm a mean person, let's just say I'm an average person. What are you going to do? Keep it. They give you a couple more weeks. Well, what are you going to do? You're going to keep it. So Blockbuster's running their models, and they're saying, people still keep it the same, we give up the late fees, and so our profitability goes down 20%, but oh, by the way, people show up more. Okay, that sounds crazy just to start. But take it one level more, and you do my math, and I just took this math just from, here was the cost per day for Blockbuster, which was just 1.15 divided by 3, gross profit per day, revenue per day. And I say, okay, let's say people keep the movie actually 5.5 days. So on average, everybody goes from holding it 3.5, they hold it a couple more days, and I can't get in, I don't know what the math is going to be. I just feel like people are going to rent more. And look what happens to your gross profit per movie. It goes to $1.69. And your business is absolutely destroyed. Okay? So I'm selling all my movie gallery. Here I'm selling it already. There I'm saying I'm definitely selling everything. Arguably, this is a disaster. I also know he's cut the Netflix fee, what was the Netflix cost, down to $15. So that's just a disaster. And everything's, yeah.
I'm not quite sure about the leap from Blockbuster to movie gallery because, as you said, people are irrational about late fees, right? They don't tend to worry about them that much.
Right.
So are they really going to have to match Blockbuster? Are they going to lose share of Blockbuster because just because Blockbuster?
Right, and I think that is very fair. And I sat there and I said the same thing. And I said, I don't know. I know that it's bad when someone who holds 40, 50% share in a business I'm competing with is cutting. I know movie galleries aren't completely exposed to Blockbuster.
I think that you might have said, well, okay, now I'm nervous about movie gallery, I'm going to sell Blockbuster.
And I did. And I said Blockbuster, I didn't own, but Blockbuster, I actually said I'll short Blockbuster. But taking the movie gallery, I'm sitting there saying, I don't know what it's going to do. But I do know when a big competitor who basically owns the industry cuts what I think could be profitability 40%, I'm pretty nervous, and it's not a place I want to hang out. So I'd done all this work, I got excited about Blockbuster, and then 3 weeks later, he's telling, he's doing something that's basically leading me to say, there's better places to be than this. And that's kind of where I was. I didn't know what would happen. And that is kind of where I was. I was, okay, let's short Blockbuster. And I don't really short stocks, but this seemed too good to be true, right? And I said, let's get out of movie gallery, okay? I probably have another 10 minutes at most. So probably better just to keep going. So what do you do? And I told you what I did. And what happens, and remember that was all January. So movie gallery actually doesn't really do much, right? It goes up. And I've sold it now, right? It decides to go up some more. So exactly what you're saying, right? So it's at 22. Now it's going up some more. And mind you, all these facts are out there, right? Movie gallery is going up some more. And this is where I was talking about 350 in EPS. And so it's actually doing what I kind of thought, but I'm not benefiting. I thought 350 in EPS, it's going to get to 28 bucks. Goes up some more. And then if that wasn't fun, it goes up some more to 32 bucks. So I don't own it. And I thought they'd do 350 EPS, and I'm probably kicking myself. In fact, I am, because I'm saying, God, how could I be so stupid? This was the biggest layup ever, and I had done all this work, right? What's Blockbuster doing? This is 2 months after. So all these facts are out there, right? And everybody's running around. Blockbuster's great. Nothing's really going on. And Netflix, which I don't have the time to go into, but I know Blockbuster's cutting price, so that's scary, but there's some other reasons why Netflix becomes interesting. And Netflix is just hanging out. So here's where I am. Made money in round 1, didn't make money in the round 2 of Hollywood, which was the second buyout. Thought I was going to make a lot of money on movie gallery, and then nothing. I'm watching the stock go to 32. BBI is interesting as a short because I think everybody's just nuts, and I don't quite get it. And through all that work, I become interested in Netflix. So remember where we started was just Hollywood and just going to some presentation, and now you're like 4 derivatives down the line with all these multiple opportunities. And so where we were kind of mid 05, and then movie gallery decides to have some bad results and some things are happening, and Blockbuster is really having trouble with this whole late fees thing and goes down and down. So now I'm happy again. I'm not short, but at least I'm not feeling like I'm the dumbest guy on earth. And then it decides to go down some more. So that's where we are today, 680 on movie gallery. So what's amazing, and I look back and I kind of say, I missed the run, but I prevented myself from getting destroyed. And there was time. I mean, it wasn't like the late fees thing was a secret. It wasn't like the 10K was a secret. All that stuff was out there. So you didn't even have to be the fastest guy. You just kind of had to think about things a little bit more. And it was really amazing. When movie gallery got to 30, was really actually tough to stomach. Blockbuster finally, when they finally decide to tell everybody, hey, this no late fees thing isn't working so well, finally falls out of bed. And where I really made the money was Netflix, bizarrely, which is never what you would have expected. That came out of the blue just through all the other work you'd done and everything. So all the work paid off, mostly in this, some in Hollywood. I never really made money on movie gallery and made some money on Blockbuster, but it's not like I short that much, so Blockbuster wasn't really where the money was made. And that is it.
You want to just tell them a little bit about Netflix, what your thinking was?
Yeah. So earlier this year, Netflix was at 10 bucks, and there's 60 million shares fully diluted, and they have a couple $100 million in cash. So it's basically 400 million enterprise value. And Netflix had call it earlier this year, 3 million customers. And the facts that I focused on with Netflix were that Netflix in the San Francisco area, when I say San Francisco area, I mean Oakland, San Francisco, San Jose, counting the suburbs, the whole thing, had 11% penetration of that market, which is amazing. 11% of the total households in San Francisco were using Netflix. And all the other markets that Netflix would open up in were tracking. The key for Netflix is when you go one-day service. Netflix used to offer 2 or 3 day service. The key is you send it in, they get it the next day, they mail it out, which means you have to have distribution centers close to people. And all the other markets that they added one-day service to were tracking along that same penetration rate as San Francisco. And you could say things like San Francisco is more tech savvy, more internet savvy, and I'd agree. Some people would say San Francisco, people in San Fran have more things to do with their lives, or not watching as many DVDs. At the end of the day, I kind of say San Fran is, including all of San Jose, Oakland, and the whole deal, is pretty representative of the country, or at least the major metropolitan areas in the US. So I was pretty excited about that. And I looked at it, and they were making, this year, Netflix is going to make no money, charging $18. But in the face of charging 18 bucks and Blockbuster charging 14 bucks, and you have all the figures, you know that Netflix was actually still gaining subscribers despite the fact that Blockbuster was charging $3 less, was giving you 2 free in-store rentals. So in addition to the 3 movies out at a time, Blockbuster is giving you 2 free in-store rentals. And I said, wow, people really like Netflix. For whatever reason, call it Amazon versus BarnesandNoble.com. People go to Amazon. You would say BarnesandNoble.com should work real well. Netflix seems to be working really well. So you have a subscriber business with the churn was probably 5% at the time. But the funny thing about churn is that cell phone churn 3 years ago was 4%. Every month, 4% of them, they lose 4% of the customers. Businesses churn, particularly when they start. It's natural. What happens is people stick with things for a longer period of time, and then the initial people who were trying it out, trying to figure out what it was, stop churning, and then your churn heads down. So all that said to me that Netflix with 3 million subscribers, growing 50% year over year, all this different stuff, if they could just get $1 or $2 more bucks out of every subscriber, because they'd either increase price or because their churn would go down or because they'd decrease advertising as people just told other people about it and they didn't have to advertise so much. I'm going math real quick, but at 3 million subs, if you got an extra $2 a month, that'd be $6 million a month, that'd be $96 million a year. And for a great business with 96 million, what did you say?
72.
What did I say? I said 6 million. Oh, 72? I just said, 6 million, my math is off. No, 72. Hold on, I'm off track now. 72 million bucks. So if you're doing 72 million bucks and you put a, I don't know, great business, high returns on capital, all that different stuff, and you put a 12 times multiple on 72, got you to 900 million on a business that had an enterprise value of 400 million. And that was kind of Netflix. And there's more work. I don't want to act like it was just that, but yeah.
Did movie end up cutting their late fees? What caused
No.
the drop from 30 to 6?
What caused a drop, and it's still not 100% clear, what caused the drop is it's heavily levered. Hollywood, which they now own, is comping down 11%. Blockbuster is comping down a couple percent. I'd argue what's happening is that Blockbuster is drawing on the margin more people to their stores because they have no late fees. So people who could choose between Hollywood and Blockbuster may now be going to Blockbuster because they have no late fees. And that's what's killing movie galleries' business, along with a lot of the trends have continued to be mediocre. But in the face of all this, Blockbuster is still comping down probably 3-4%. And Hollywood's comping down 11%. So you never know. Like, it's not like it's a clear answer. All I knew is that it wasn't good, and I didn't want to be there.
Did you look at or read any research on the impact of higher oil prices on rentals? Like, are people, or is that just not a factor of the
Maybe that's happening now. At the time, when I was looking at it, it wasn't a concern. Yeah, I mean, I'd say maybe that's hurting them a little bit. People aren't driving as much. It's a video rental. It's not like it's, you still got to go to the supermarket, which means you still got to pass by Blockbuster. If you want to rent a movie, I think people still rent a movie. But maybe on the margin, that's hurting a little bit.
Would you see the no late fee thing as irreversible, or if they get a new CEO, could they say, well, that was last year?
Yeah, and that's, if you ask me now, I would say that that's probably the most interesting thing for any of the stocks, is that they just take it on the chin and say, we're bringing back late fees. And I think that'll help a lot. I don't know if they'll do it, but that's probably the most interesting thing. Yeah.
The no late fees thing, once someone realizes that they end up paying a restocking fee anyway,
Right.
they kind of realize that that's not, they're paying one or the other. So, how much of an impact can this no late fees thing have longer term once customers kind of figure it out that they're getting hit anyway?
Well, they're not getting. They're keeping the key is that they're keeping the movies much longer, and they're kicking up Blockbuster's inventory cost. But I'm confused. What are you saying? Are you saying at the end?
The attraction to Blockbuster is for the no late fees, and that's what's kind of eating away at some of these other guys.
Right.
Why they're taking business away from movie gallery, through
Yeah,
Hollywood, let's say.
Right.
But once a customer kind of realizes that he shows up a month later with the videos and they're charging him a restocking fee.
Well, the restocking fee is only 75 cents. So you basically pay a late fee of 75 cents for holding a movie 30 days. It's a price cut. I mean, Blockbuster cut prices. Any way you look at it, Blockbuster cut prices. They didn't do it on the surface. They cut it via the late fees. So I guess I just view it as it's a price cut. So I think it's cheaper to go to Blockbuster than if you ask me, if I'm someone who thinks I could incur a late fee, I'll go to Blockbuster over Hollywood right now. No question.
Just a quick point. Did you know the penetration of video on demand before you got into this?
Yeah, and the story on video on demand, and it's still a story today, is that it works great for like HBO, some different series, some extra movies. But Comcast, you can go read the transcripts of all their conference calls. No one's having that much success selling movies. And you can go through them all, and they'll all say the same thing, which is, yeah, it's not working so well. And the reason is because they can't get the new content, and that's what rents.
How do you think about an industry where you look at it and you say, I think 5 years down the road, maybe a little bit sooner, maybe longer, this is actually going to be a really bad business to be in. But near term, 2 years, 3 years, you think that the company's going to be the only one in it, or it's going to be doing well, or how do you think about sort of, okay, I can get into it and kind of try and get out before this sort of sentiment hits? I mean, is that sort of market timing then, and sentiment, or do you avoid those, or?
It's hard, and I guess that's the whole thing. Is it's just it's a question of how much cash is coming in today and how bad you think it's going to be. If you told me video rental is definitively going to die in 3 years, and I knew that, then I wouldn't be interested. But it's all a judgment. I wouldn't touch the ones that I thought were completely dead in 3 years. That's kind of the whole thing. Is how much life does it have? Right. It's hard to answer.
5 and further, you just sort of, that's too far out in the future to really.
It's the same. If you thought in 5 years a business was going to fall off the face of the earth, you probably wouldn't be interested. If I knew it was going to die definitively in 5 years, it's hard to find something where you, at a price, everything is worth something. But hard question to answer, I guess, is it all depends. It depends on where you are relative to. No. Yeah.
Understanding that movie gallery is heavily levered now, at what point would it become more interesting again?
It's hard. The lever. I mean, at this point, the movements in the stock price don't mean much because it's got 1.1 billion of debt and it's got 30 million shares. So you're talking about what I would call, in that example of equity stubs or just option bets. It's an option bet. If the stock was at 10 versus 6, it makes a difference in terms of risk reward. It doesn't make a difference in terms of the valuation of the company. So it's hard to say.
What do you think would happen if, or what do you think the odds are that Blockbuster sort of wakes up and says no late fees, or
50-50? I think 50-50. Yeah. I think that it's a public relations disaster, but it's Carl Icahn. This is this. Carl Icahn's in Blockbuster on the board, and he's yelling. And so there's a chance. There's a good chance, but it's.
So what would happen to movie then?
If Blockbuster cut late fees, I think movie would be at least like $13-14.
And it's where?
And it's 6-7. Yeah, it's movie gallery is falling fast, and the banks could shut them down. So it's dicey. Yeah, that's what I would say. I wouldn't say, if someone told me they own movie gallery, I wouldn't say they were nuts at this point. I'd say, it's an okay bet. Okay.
All right, well, that was pretty amazing. Thank you, Brian.
Am I missing something? All right, so if you're going to do a group, I may have a few of you present. So I want to, who thinks they're going to work in a group and who's going to work by themselves? So let me see group. 1 or 2 people. I mean, 2 people has to be a group, right?
Not 3.
I said 3 last time, didn't I? All right, so 3. All right, so show me a group again. All right, now take down the hands of the people who, all right, just 1 person from each group. How's that? So we have 1, 2, 3, 4, 5, 6. All right, so I'm going to let the groups choose first. And then, all right, so show me again just 1 hand from each group. Okay, so we'll start from Ethan. Tell me what it can't be a company you worked on for another class or something that you handed in last time, because some of these are repeats of papers I got. So it can't just be the same thing rehashed. So Ethan, pick a name.
We'll do K-Swiss.
K-Swiss. All right, so everyone with the groups, write down everyone in your group and the name of the company. So K-Swiss is taken. Okay, who is one person from another group? Steve? What? Corinthian. I should go through these anyway before you do that. Corinthian is Cocoa at the end. Okay, so that's controversial. So this is Corinthian colleges. So this one is Rent-A-Center, Lexmark, Interpublic Advertising Agency, Pfizer, we know, Mattel, we know, U.S. Tobacco. This is American Eagle, Foot Locker, Fossil, Gap Stores, Timberland, Kenneth Cole. This one is Career Education. K-Swiss, we talked about King Pharmaceutical, Marvel Entertainment, NCO Group is Accounts Receivable Management, OVTY Omnivision, Tempur-Pedic, Infospace, Columbia Sportswear, Domino's Pizza, eFunds, Arkansas Best, Kindred Healthcare, Liz Claiborne, Petco, Premier Global Services, a document delivery company, Winnebago, and we already had Corinthian taken. All right, so next group, Steve, you're going to... Oh, you just did. Okay, so you'll give me a sheet of paper with the names from your group. Patrick.
Foot Locker.
Foot Locker. Okay. Dan, you're in a different group?
Yeah, from the group Mattel.
Mattel is someplace over here, right?
Yeah, number 5.
All right. Steve.
We'll do Columbia Sportswear.
Which one is that?
COLM.
Okay.
Third row.
Timberland, you didn't work on this before? Nobody? Okay. Chase. Which? Rent-A-Center. Okay. That's a good one. David. Winnebago. Are you in a group?
Oh,
All right, who's working alone?
can I do OVT?
Oh, wait. I'm sorry. What?
Oh, sorry, what was it? Chris.
Hold on. Who's in a group?
The three of us are in a group, and so we're trying to. And Chris is
Okay,
speaking
so you're
for us.
picking 3 different names and you work well together.
Chris is speaking for us.
We do Sika.
Okay. Good enough. That's career education. That's controversial. Good. Any other groups? Or we good? So how many groups do we have? We have 1, 2, 3, 4, 5, 6, 7, 8, 9. Wow. So I might have 1 or 2 groups, and I'll let you know via email. You'll give me the names now. I'll let you know via email who I'd want to make a very short presentation on the 16th, and then they'll also perhaps, why don't we just leave it on the 16th, because I think the next week is Thanksgiving, and then the 30th, we don't want to waste time on presentation. So I'll probably, out of these groups, 1, 2, 3, 4, 5, 6, 7, 8, 9, I'm going to tell you the day before, so whether you're going to make a presentation, so I guess that will make all of you prepare. But you'll have to hand me...
Actually, I hadn't seen Interpublic. Can I take that one? I apologize.
As opposed to?
As opposed to Mattel.
Yes.
Trouble company will, I mean, they're both troubles, but Interpublic, I think, are about what we'd rather do.
It's not as much fun in games, right?
We don't have class on Wednesday, right? So the 16th is the last. I'm asking.
16th we have a class, then the 30th we have a class the 9th, then we have the class the 16th, then we have the class the 30th, then we have final on the 7th, which I think it's the 7th. It's the last day of class. We're going to have a final for the period.
Do we need to email you or just give you a sheet of paper?
No, I need a sheet of paper here today with everybody's name on it and these groups, and I will email you a couple days before who's going to be presenting so that everyone hopefully will prepare. So all 9 will prepare, maybe only 4 will present, just to be fair. Who is not working in a group? Who's working alone? Okay, so why don't we pick some names and you'll give me a sheet of paper with your name on it and which one you're doing. James, what are you going to do?
Well, I
I'm sorry, I missed the first part of this. We're only allowed to do something from that?
Yes.
There? Okay.
And you can't be something you worked on before.
Okay. I'm not sure what all these lines are.
Oh, okay. I'll go through them again. Who else?
Sorry.
Do we have to go long or do we go short or what's?
Any of these? I just want your analysis. If you say if it comes out short, then it's a short.
Look at it and tell you.
Right. In other words, what I'll want to do is just a little bit more in depth. It doesn't really have to. We're going to go over your first. I'm going to give back your first papers in a second. I'm going to go over some of the things I found in the papers just so that everyone can learn from them. And then when I get the new ones and from the people you saw presenting over the weeks, hopefully the next paper will be somewhat better. Similar format. It could be slightly longer if you want, but I'm just going to go over a few things of things I really want to see, on the next paper. You all did a good job actually on the first set, and I'm just going to go over a bunch of stuff. So in the meantime, do you have which? Oh, Kindred Healthcare, yes. Okay. Anybody else working on their own? This is Lexmark, printer, Pfizer, Mattel, U.S. Tobacco, American Eagle, Fossil, Gap. What did I say that was? Kenneth Cole, King Pharmaceutical, Marvel, NCO Group, which is Accounts Receivable Management. OVT is Omnivision, Tempur-Pedic, Infospace, Domino's Pizza, eFunds, Arkansas Best, Liz Claiborne, Petco, and Premier Global Service, which is a document delivery company. Yeah.
Maybe Marvel.
You may do Marvel. Okay. Next. Roy. Tempur-Pedic. I'm curious about that just because I just got one. Chris? Which? Domino's. Okay. I heard of them, wherever they are. All right, Domino's is third column. Domino's. Yes, you can. Adam. Gap. All right. A couple people wrote up Gap, but if you weren't one of them, you get to do it. It is cheap. Just a hint, but you'll probably figure that out. All right. These were picked from a number of different sources, but all meant to be somewhat interesting. So, not randomly chosen. Oh, you didn't pick?
Petco.
Petco? It's all yours. All right, good. All right, so we're good with that. For those of you on videotape, please email me your picks. Did you scan the board already? So, and you can pick anything that's not circled. If I get a duplicate, I'll live with it. All right. Basically, briefly, and I really can't speak as fast as Brian. By the way, he was great, right? Yeah. Brian actually... So everyone will hand me a piece of paper of what they're working on for the project. Brian was actually our analyst for a few years, and he went out off on his own. He's still works out of our office, and we didn't want to lose him. He's too smart and good. So, but you truly don't have to be as smart as Brian. He's very exceptional. I'm not as smart as Brian, if that helps. All right, I just wanted to make a few comments on the paper. In general, they were very good. I think for a first attempt. I guess big picture, I would like a more concise pitch. I think Bill Miller, I was looking for this the other day, but I read an article from Bill Miller. And if you know who Bill Miller is, he runs one of the Legg Mason funds and it's done tremendously well. I think he's beaten the market every year for the last 14 or 15. Interesting value investor. But they run billions and billions of dollars. He hears many pitches all the time, so he just says, I want it fast. And it helps you if you can summarize it very quickly, like this company's trading at, it's out of favor now, it's earning less money, but if you look at normalized earnings, it traded 5 times normalized earnings, returns on capital are 50%, they're closing their money-losing division, and that's why people don't see it, or people see it this way, and that's why I think it'll get better, or whatever, and you should be able to say it you should be able to spit out the pitch and even the valuation portion of why you think it's cheap in a few lines, really. And then I want to see all the backups, same thing. But it's just very good practice for you to understand why you're buying something or not buying something, or, you know, this is what I thought and this is how it turned out, or whatever it might be. It's a little harder when you're assigned something. Because you might not have a strong pitch on it. You might say, well, it looks pretty fairly priced, but I went through this and this, and if I use normalized earnings, it comes out to be, you know, within the range of fairness. Or I can't predict, I can't really predict what normalized is. Or I can't, you know, you could pick Blockbuster and say, I don't know where earnings are going to be. I have to stay away. Here's 3 scenarios, and if it hits this one, I'm going to lose a lot of money, and I don't have a confidence in which one's going to really hit in the end. You know, whatever. In answer to the question, which was asked to Brian, by the way, which is, well, how do you evaluate a company that, you know, if earnings are going to drop off a cliff in 3 years, 5 years, or whatever? I mean, it's really not more than a discounted cash flow question, right? I mean, you make your assumptions. If you can buy at half of what all the cash you're going to collect, then you would buy it. It's not a Warren Buffett pick, but it's a way to make money if you think you're going to collect that. I mean, you don't have to make it super complicated or have something to remember or anything else. You're trying to figure out what the thing you're buying is worth, and if you can get it for a lot less, that's what you're trying to do. So that answers most questions, at least like that. The way I answer most questions is, well, I can't figure out that answer. I don't really know what it's worth, or I can't figure out what the future is, and then I really have no business investing in that.
For Blockbuster, if you were to do a DCF, how do you think about the terminal multiple? I mean, maybe someone would want to buy it if the cash flows continue to decrease, or you just use a perpetuity growth rate?
You know what? Me personally, I wouldn't get that complicated. I'd say, what are they going to earn in year 1, year 2? And if I'm making projections, right? Year 1, 2, 3, 4. You know, I'll make 8 years worth of projections. Figure out how much cash I'm going to make in that time, and you know, figure out what that's worth to me. You know, if I pay $5 now, I'm collecting $10 over the next, you know, 8 years, and 2 are next year and 1 are this year, and it works into a, you know, IRR of, you know, 24% on the money that I just invested. That might look pretty good. You know, that's probably what I do, because A, who cares how much I'm making in 9 years, especially if it's going to be next to nothing based on my assumptions, and so discounting that back is just not going to change the big picture. And I'm not looking for exact answers. I'm looking for, hey, you know, I think it's going to be worth, I'm going to collect around $10 in current value, and I'm paying 5 or 6. You know, it could be 8, it could be 12, but, you know, it's probably still a pretty good bet there. So that's really what I'm looking at. Oh, anyone have any quick questions on Eric's presentation last week, by the way? Risk arbitrage. I think at the end, you know, and a lot of people sort of misunderstood what I wrote in the book about risk arbitrage. I said, don't try this at home, which means not that it's a bad place to be, but it's not a place for amateurs, and you have to do a lot of work. What Eric said is spreads are so thin, and you know, people are setting up spreads for 8% annualized or double the risk-free rate or whatever. I never looked at the business that way. And I think that's the flaw a lot of times. I look at it as a risk-reward business. I can make $1, I can lose 10, okay, because it's all happening in 3 months. And people, a lot of places set it up as a return, you know, an annualized return business. But one annualized return may be a lot worse than the other if you could lose 10 and make $1. So people just look at it the wrong way. It was always my complaint about, you know, too much money chasing that business, and I don't think it's particularly relevant right now because, you know, it's, you know, plain vanilla arbitrage is not too good. But there's always interesting things when something's changing. I mean, Brian just went through the takeover battle for Hollywood, right? I mean, there was a $14 bid, then they went down to 10 1/4. There's a lot to think about. That's an interesting one, right? If you have a strong valuation opinion and you understand how takeovers work, which is, you know, there's a lot of back and forth and game theory and everything else that you're trying to figure out. Well, he's just trying to get a cheap price, and that guy's still buying it, and what are his incentives? I'm looking at the CEO, he's buying in here, so he's not fighting too hard for them to cut the price, and they're still interested. They didn't walk away and say, oh, you know, if they thought, oh no, the business is imploding, it's going nowhere, they probably wouldn't show up again. So there's a lot of signs you can read. There's a lot of stuff going on there. So it's still a fertile ground, and we talked about, you know, and there's merger securities, and there's interesting things, and they're to look at, and sometimes there's overbidding, you know, if there's too low a price, or if management's taking something private, or any of those things. There's an opportunity to make some money along the way. So I'm not saying, I really wasn't saying ignore this area completely. I was just sort of saying it's its own special area, and you know, I originally, believe it or not, didn't write that book for, or that I hadn't taught MBAs yet, so I didn't realize that I had really written at an MBA level, and I just thought, oh, everyone knows that, but I'd been doing it for 15 years, and you know, didn't realize that. So I really meant for lay people, you know, not to jump in there thinking that it's so easy to do, and you can just figure out a spread and play the business. So didn't want to discourage any of you from looking in that area. Okay, let me go over a few of these things, then any questions that come up, just we'll throw them in. This is no particular order, believe it or not. I just went through the papers and made some comments on each one. And if I'm talking about your paper, don't take it personally. It's really, I'm not going to mention any names, and everyone did a pretty good job, so I wouldn't worry about that. You know, a bunch of people slapped on 12 times EBIT numbers. And I don't do that lightly. It has to be a pretty good business to trade at 12 times EBIT, and people threw around high numbers for a while and say, oh, it's trading at half that, or whatever it might be. Well, I'm just telling you that's a high number. You know, we talked about 10 times EBIT is sort of, with a 60% tax rate, is kind of similar to our 6% government bond yield, right? But that's a pretty good business that you'd want to, you know, trade at the same price as a government bond. So that's just 10 times EBIT, and to get to 12 times EBIT, you want to be pretty certain of your income and your growth. So I wouldn't throw those kind of numbers around so lightly. There are certainly businesses that are worth more than that, but it ain't cheap. You know, once again, if it's tough to know what normalized earnings are, sure, if they're making you do the project, then you have to try to come up with something. But generally, the best thing to do is move on to something you can analyze. If you can't figure out what normalized earnings are, you don't have a clue. I mean, sure, you'll be wrong sometimes, but if you really can't figure out that one number, you just don't know what the company's worth, and you can't know what it is. So generally, I would just try to skip. I mean, there was one written about a local airline business, and it wasn't clear whether their competitors were going to come in or they weren't going to come in, and you can analyze the barriers to entry and, you know, what's happened to other local airlines when, you know, low-cost carriers come in and everything else. Bottom line was, yeah, you know, on one hand this, on the other hand this, on the one hand this, and you know, the earnings could be zero, they could be pretty good, they could, you know, at a point, it's just not, or at least I didn't see presented the analysis as to how you could feel comfortable with any kind of normalized numbers was the point. Here's another thing where sales over the last 2 years have grown from, you know, whatever you want to call it, 800 million to $1.2 billion, or 8 billion to 12 billion, or 80 million to 120 million. Might be a little different. Company was, you know, related to the housing market. So the question is, to grow things from here, you know, that's 50% growth in a couple of years in this particular business. You'd have to say, you don't even have to have a housing bubble. You can just say this is above trend, you know, and just to assume this and grow it. When you've seen such huge growth, right, usually the models make it easy just to stick on, it's going to keep growing 5% a year, 8% a year, 10% a year, but maybe you don't start at 12, maybe you'd start at 10 or 8, or you look back 5 or 8 years and try to maybe you can't figure it out, but this certainly isn't a conservative assumption to say that, you know, we're normalized, or I'd want to see a case as to why you thought that things were normalized there. So I would just look out. If something's grown a lot, it can get pretty scary to project the last year into the future. All right, had a really interesting paper on a company. And it was sort of like a Sears Dean Witter company where you, if you buy Sears and you short out Dean Witter and you can short out Allstate, right? Then we can create the stub for really cheap. And, paper was great. But sometimes it pays not to just blindly do that. Yes, you can short out the stub cheaply, but I just want to point out that sometimes it's worth analyzing the underlying companies because you may not want to short them. In other words, it may, it's worth doing the analysis on all the pieces. A lot of people just do the stub analysis, and I would just say there's a lot of moving pieces here. Sometimes you don't want to short out that thing even though you could. Or let's say that you can't. One of them is not a public company by itself. Then you would do the analysis, and that's easy. But when it's so easy to short it out, most people just don't even look at that piece. And I'm just saying that's another place to potentially make money, or at least not add another element of risk, which is shorting something out, or could add some upside by not shorting something out that you think is reasonably cheap. Let's see. All right. Here's something. Let me see. This is very important and very simple. Remember I told you the two metrics that I want to see. I think you remember that. When I say EBIT, I'm really talking about EBITDA minus maintenance CapEx, but we'll call it EBIT here. And we say net working capital plus net fixed assets. Right? That's basic return on capital. And then earnings yield, we'll just call it EBIT to EV. And then I said, gee, it would be nice to know what those are normalized. That's sort of what I want to see. And that'll tell you two things. A, what kind of business you're talking about. Is it a good business? And B, is it pretty cheap? How does it compare on a pre-tax basis? And once again, when I look at EBIT to EV, which is earnings yield, and I'm comparing it to the bond rate, this is pre-tax. This is after tax. So this would be the equivalent of 10 times, 10% yield here is the equivalent to this at a 40% tax rate. So I'm comparing these two. Yeah, but that's not my point. Yeah, go.
Just when you look on the return on capital calculation, what do you consider a good return pre-tax?
That's an excellent question. Some people were saying, pre-tax return of 14%. That's good. And generally, that's not good. If you're asking the question, I would say this is sort of the area. This is not pre-tax. This is after-tax return on equity that most companies. That's average for most companies, somewhere in here. So that would mean divide by 0.6 for me, whatever that works out to. At 20%, for instance, pre-tax return, where at 40% tax rate is sort of a 12% return. I think it's still pretty good because these are companies that you would see, public companies, a lot of companies that fail that you never get to see. So this is, decent operating, but it's not amazing even. At 20%, you have room for error because after tax you're at 12%. Now you can say, well, if I can borrow money at 5% and stick it into something, or I can borrow money at 8% and stick it into something that's going to earn me 20%. It depends how confident you are in that 20%. That could be very good. Okay, that still could be very good, because especially if you could leverage that up and do a lot of it because it's a certain 20% pre-tax. That's one thing. So part of it, all earnings are not alike. Some you have super confidence on and they're going to last for a long time, and then 20% pre-tax would be great, even though after tax it gets you to sort of an average rate of return. But an average business doesn't have security, doesn't have longevity, doesn't have potential growth. There's a lot of things to it. So I would sort of say start to be a good business 20% and up, 20% and up is what I would look at. Start to at least say, hey, I might be in good territory here. I personally like to look for more than that. It just gives me more margin of error, and really depends what you're paying for it and a lot of other things. But this gives you some semblance that this is kind of average. Average isn't necessarily bad, depending on how cheap you can buy it, but this is sort of what America does for regular business after tax. Rich Pizzina makes all kinds of models up. to value the market, where are we, sort of like the Fed model, I don't know, using interest rates and average returns on equity and this and that. And if you asked him what he thought average returns on equity were in a normal environment, 12 to 13 is sort of the neighborhood after tax, if that helps. But there's a lot of other things that go into it, because 20% certain that might even grow a little could be great. But that's where I would usually start. Did that help? All right, so let me just go back to this. So I'm figuring out normalized, and then someone says, you know what, I think conservatively this thing's earning, let's just say this works out to 40% returns on capital, so it's a good business. And now earnings yield, I'm going to be conservative. I'm going to take normal earnings, 3-4 years out, and say it's $5 at, so I think that's worth 10 times EBIT conservatively because we have a good business here. And so you come out with $50 of enterprise value. That's what I think the company's worth. It's traded, let's say there's no debt, so it's $50. And the stock's at, 35. So the stock's at 35, it's worth 50 because that's normalized earnings in a few years. What did I leave out? Patrick?
You're not annualizing the rate of return?
That's not what I was thinking. It's very simple.
Downside?
What?
Your downside?
No. Yes, all those things will still come into play, but I'm just saying when I do my analysis and say, look, it's trailing at 35, 10 times normalized is 50, and it's going to be worth 50 in 3 years because that's what I think it's going to earn in 3 years. No, I assume no debt here.
You have to add in the cash generator.
Exactly, that's what I was just thinking. A lot of people said, okay, it's going to be worth, they did the analysis and said, look, I'm paying 30 or 35 for the stock today. I think in 3 years it'll be at 50. That's X rate of return. Okay? But you earn money in the meantime. Some people had 5-year projections out to here. This is normalized earnings in 5 years. Put a multiple on it. I'm buying it at half that, so I'm going to make X percent a year. Okay? But they let you earn cash all the way through. So it's not just a multiple of your end multiple times normalized earnings. And that's what I'm going to make 3 years from now. You also have to include the cash that you earn in the meantime. Just a few, I'd say 3 or 4 people did that. Just left out, would have made the case stronger if they included the $3 a year they were going to earn over the next 4 years into their analysis. Just one other quick thing before I forget it. Here's another thing. When you're doing your EV analysis, and you subtract cash from debt to figure out net debt, or net cash, when you're figuring out cash minus debt, there's $5 a share there. Cash does not necessarily mean excess cash. Okay? You can't always just take the cash number and say, okay, that's excess cash. Every business is different. They have different working capital requirements. You'd have to try to figure that out. One of the things that I would get, and there are negative working capital businesses, and you'd have to decide whether this was one of them. But generally, I don't take cash out. If I'm putting myself into a negative cash flow situation, I assume I need working capital for my business. So what I start backwards and say, how much working capital do I generally need for my business? And then whatever extra cash I have is extra cash. But I wouldn't just take the cash figure blindly. I would try to figure out. Sometimes you can't, sometimes you can, and if you can't figure it out, I'm extra conservative. How much do they really need in the business? How much cash do they really need in the business? So I just, pretty much anyone who did that just took out cash without saying, probably didn't do the analysis. It might be correct to do it that way because all the cash was excess, but it's not necessarily that case. And certainly if you put yourself into a negative working capital situation by taking out the cash and saying it's excess cash, that's one way to determine that perhaps you went too far and took out too much cash. We had a question, I'm sorry.
Just generally on when figuring out your EV, besides the cash, you're also going to put in all preferred,
yes,
all operating leases and just all that stuff. Okay.
Well, operating leases, you mean like if you have a retail store? My sister Linda's going to be here on the 9th, which is this coming Wednesday. She almost exclusively does retail stocks. She's done incredibly well, high 20s return over the last 8 years, just staying in one area, which I think is really cool because it just says if you learn even one industry or one area really well, you can just do that. There's enough diversity there, especially if you're patient and wait for your opportunities to make really great rates of return. And, it's sort of, if you're good at something, keep doing that thing. So that's sort of that kind of philosophy. Anyway, she's going to come and maybe when she's done, we'll talk about how do you deal with operating leases. In other words, let's say in retail, for instance, some places own the stores and the land, right? And you're going to figure out ratios, and that's one thing. And some places rent all their stores, okay? And so it doesn't show up as debt on the balance sheet, but do you include it as debt or not? And there's interesting questions about that because if you have a 20-year lease for a store, that may turn into an asset one day. In other words, you have a 20-year lease and real estate values go up, and even if you close the store, you could sublet for a lot more than what you're paying for the store. So it could be an asset. It's not complete debt because there's sort of an asset there, which is the remaining part of the lease, so you can sell. You might take a small loss. Let's say even rents don't do particularly well and you have to sublet, you'll take a small loss and sort of get rid of that debt in a way more easily than you could if it's in plant and equipment and a factory that's not doing well or something like that. So to throw it on and just say it's debt, there's an asset on the other side, which is whatever the remaining lease term is. And generally what I do is I just when I look at a retailer, big picture, to give you a little heads up, is I just compare apples to apples. So in other words, if a company is hugely profitable and we find a model that's earning 60 or 80% on any store and you feel it's not a fad business, you feel that it's in a pretty good business and you're not going to worry about leases. I don't worry about them that much, me personally, as debt for two reasons. One, because I'm not really that worried about a few stores not working out because there's such margin of safety in how well they're doing. And the other is that I still have an asset to get rid of. In other words, I am on the lease, but usually you can sublet and get something for your lease and you're not on the hook for all that debt, even if the store didn't work out. So it's a lot of ways to look at it, and so I don't have a general rule. I just look at it in every different way. How confident I am that I'm worried about that debt down the road. And then maybe you get the benefit of that. I might look at a company that owns its stores and say, I might try to figure out what it would look like if they lease the stores also, to compare apples to apples. And, so it's not a hard and fast rule. I'd have to look at the situation, decide whether I'm really taking on that risk. What are the locations of the stores, and also what's the quality of the business where they're opening it. So.
Just to go back to the point you mentioned about the earnings and getting the cash. Once you kind of have your projection for earnings, you make some assumption that they're going to make a certain amount of cash each year. You need a certain amount of CapEx to get free cash flow. And you're assuming that remaining cash will be paid to you as a dividend. Is that the assumption you're making, or how are you?
Well, I have to make that assumption, but if let's just say there's a big holder, 15% holder of the stock or whatever we were just talking about, then I assume the cash will be not wasted. So in other words, I'll get that cash either through buybacks, through dividends, okay? If I see them making big acquisitions, then I'll have to determine whether these guys are good at doing that, and my usual supposition is no. I'd rather them not do that with the cash. So either I'll get it because someone takes them out and I'll get the money that way, or they'll give it back to me in dividends or stock buybacks. Generally.
That could be a little bit aggressive if you're looking at a 2-year thing that you'd actually get that back, right?
Right, but as far as valuation is, what is it worth in 3? If I'm trying to figure out what something's worth in 3 years, I'm not assuming that it's there. My only point was people are just giving me the earnings value of the company. They didn't give me any of the cash build during that time. They could either pay down debt. If they have debt, then I should get credit for paying down some of my debt, okay? Or I should get credit for the cash. Or I'll make an assumption, hey, for the last 5 years, either in Moody's or Duff & Phelps or wherever, they spent every nickel buying back stock. I'm going to assume they keep doing that, and I just have to guess the prices as to what they're going to have to pay to buy back that stock.
I guess one thing I was thinking is you don't have to actually get the cash back, right? Even if they
they just generated the enterprise value, like if it's trading at 10 times now, if it trades at 10 times in a year, the enterprise value of the stock price doesn't move, will go down because net debt will go down. Like the cash will just increase. You don't actually have to get it paid back.
Well, you have to adjust for it, is all I'm saying. If you do, you can say, oh, I'm paying less of an EV because you calculate it that way because I will have paid down some debt. That's fine. I just want you to take it into account. It's not just whatever the earnings power is 5 years from now times a multiple. That's what I'm collecting 5 years from now. I'm just saying something happened in the last 5 years. Account for it. That's all. You account for it however you like, but just account for it intelligently. Chase.
Actually, just talk a little bit about financial companies where EBIT doesn't necessarily get you the economics of the business, and sometimes it's hard to actually discern what the invested capital really is.
Right. I will attempt to do that in another class. I'm not a specialist in. You are correct in saying that this analysis, the thought process is the same. In other words, what are the earnings? And you would have to use more return on tangible equity, more likely, and then how much leverage the financial company is using to get that. And you'd have to take that into account. So, I mean, I would go to something much more simple there. I'd be at PE and ROE. And just so you know, I mean, this works really, really well, and I've tested it in many different ways, but that doesn't mean that making it simpler and saying low PE, high ROE businesses don't work. I think someone wrote in the paper in my other class, he just says low PE, high ROE papers. And of course, that's true. That works too. This is for many businesses, and we're not talking about financial companies right now. This just gives you a much better picture because, like I said, when you throw in debt and you throw in different tax rates, you may lose what the nature of the business is. What are the operating businesses? So what does that asset make? In other words, if you're buying an apartment building and you pay $1 million for it and it takes in $100,000 a year in rent, that's a set of facts. That's sort of my EBIT to EV. It's $100,000 over $1 million. But if I put down $100,000 and I borrow a $900,000 mortgage and then you try to do ROEs and everything else, it's totally skewed. But the asset itself costs $1 million. It generates X dollars a year. And that's what I'm trying to get down to with this calculation, where when you look at ROE and PE, it gets skewed. And I'm looking at what is the underlying asset doing. You probably want to know both. In other words, because if you don't think you can take control of that asset and change the capital structure and things of that nature, you want to take those things into account. But this tells you what kind of, I'm trying to figure out what kind of business I have and what price am I really paying. And eventually what I've seen over time is that the facts play out and these are the facts. In other words, it's an asset that earns a certain amount. And if you don't capitalize it correctly, someone's going to come over and do it here for you.
What do you do with a business that has significant minority interest? So let's say you might look cheap on an EV basis, but more expensive.
Well, then you actually do your analysis. You have to take out minority interest in your EV. You know, what are you getting? How much, if you're buying earnings and someone's getting 15% of them, well, then you're only getting 85% of those earnings, right? And so that's what you value. What's my share? I mean, we don't have to make it all complicated. In other words, yeah, I have a minority partner. He owns X dollars. He owns X percent of the business. Okay, I don't own that part. So what am I paying for the part I'm buying? I mean, I just want to understand it in my head. I don't want to memorize any interesting formula, in other words, because each company presents a little differently. It's like when I make mistakes. You know, oh yeah, I made that mistake, but it looked different this time. You know, I already made that mistake 5 years ago. I made it again because it didn't look the same this time. You know, so I just want you to sort of understand where you're heading before, and then you don't have to memorize some rule like this is what I do with minority interest or this is whatever. Hey, that's not mine. That's theirs. You know, these earnings are only represent 85% of the. You know, I'm buying 85% of the company. I don't get 100% of the earnings. I'm getting 85% of the earnings. So, good. You asked the operating leases question. Also, I think there was a write-up on, let's say, a video game company, and they had different lines. One was very faddish. In other words, it was probably a product that wasn't going to, is selling great now, but just wasn't even close to normalized most likely. And then another part of the business that had a stable part. Like if you think of Mattel, they probably have stuff that goes, they probably have businesses that, you know, board monopoly or whatever it might be, that goes on and is kind of stable and it's not a fad. And then there's a section of their product line that you know, they try to come up with hits every once in a while. And if they have one and it's half the sales for the company for the year, you might want to analyze those two things separately. That's all, as opposed to putting them together and slapping a multiple on, which is what I read here. Good, we covered a lot of this. All right, the same thing when you're looking at competitors. I still saw price sales analysis and PE analysis, industry PE analysis, industry price sales. And like I said, that's fine to do if no one has any debt and you can make everything comparable. But when there's debt involved, I don't want to see a price sales ratio, and everyone has different capital structures. And that's usually the case. Oh, this was an interesting one. Let's see. Someone was figuring out fully diluted shares. So they went like this. It's just a small nit, but could add up to a lot of money. This is management options. So this is 66.2 million shares outstanding, 7.2 million management options, fully diluted shares, 73.4. Market cap, therefore, was, I didn't see, we can figure out what the price was from this, but that's the market cap, plus debt was 760, so EV was 2346, if you can read that, 2346. All right, so the 1586 was 73 times the stock price. 73 million shares times whatever the stock price is equal to 1586, plus 716 debt, 2346. Anyone see anything? Why that wouldn't be correct for the EV? Yeah.
Just the options are not haven't been converted to stock yet, so you can buy the company for the current float, right? So that's your.
Well, it's sort of getting there. Anybody else? Mark?
If you exercise the options, then don't you get a lot of cash back?
Yes. So that's all that was left out here. In other words, sure, if you want to use fully diluted and you use the stock price and it's this, and then you add that, you get to EV. But, I mean, these could be struck at $1 and they're irrelevant. But if they're struck at, $40, that's, you just left out $280 million that you can subtract off your EV. Yeah.
Could you argue that that's, I think what you're calling is the treasury method? I don't know if people call it that. This analysis still called the treasury method. Just using straight fully diluted shares, you're more conservative because you're not taking that cash, and it still works using that, and it's even better.
Yes, of course, but why not do it right? No, I agree with that. It's a conservative way to do it, and you can argue that. But I'm just saying, if I do have to eat these shares, in other words, if they do get exercised, and these are probably calculated based on some formula of how many are in the money and everything else. I would just go back to the notes and find out what the average exercise price is for the options that are outstanding, and just assume I'm going to get that cash back at some point if I'm going to fully dilute. And that's just the way I would do it. Because I'm not that precise a guy, and the answer is true that I'm not trying to decide whether the stock's worth 68 or 72 or whatever. I mean, I'm hoping I'm buying this thing at 40 or 45, and that sure I can just leave a lot of margins of safety here and there and everything else. And I usually come up with that using a fairly conservative multiple too. So that's sort of what I'm really looking at. So you're right in the sense that big picture, that better not make or break me, but I just like to know, I still like to take my best guess.
Could you go to the options again? I'm sorry. Like if you're saying if it's strike, what do you mean you get the cash back?
Oh, in other words, if I have an option as a manager to options give me the option to buy stock at a certain price. So if the stock's at 70 and I have an option to buy stock at 40, by not counting the $40, my option would be is I can exercise my option, but I got to give the company $40, and then I get a share that's now worth 70.
You're assuming the company's going to get that $40.
Yes, that's all. All right, I said that already. Oh, saw some interesting ratios. I'm sure you can all tell me, but got one of these. All right, so what's wrong with that ratio? Yeah, this is pre-tax, pre-interest, right? This is before interest and taxes. This is after interest and taxes, basically. So it's apples and oranges is what it is. You have to use EV here. Okay, so you don't want to look at that ratio. I saw that in a couple places. I appreciate the long list of ratios, but that's not a good one. Oh, here's something. This was a very good paper. It was a write-up on a paper company. And when they were, part of the analysis was, oh, they own all these timberlands that aren't needed in the analysis and they're worth X. Okay, so they own timberlands, they don't need them for their own processes, and they're worth X. But when return on tangible capital was calculated, the book value of these timberlands was included in that. So 2 reasons. One, this was way understated, but then again, you shouldn't also include it in the assets that you're using to generate income because you didn't really need it in the business. So just separate, when you do your calculations, try to make some sense of it. In other words, what you want to figure out is what assets and what working capital is necessary to operate the business and earn that money I'm talking about. And if it's not, it's separate. Value that separately. That's all. Okay, let's see. Price sales, lots of debt. Okay. Did I ever tell you about that story about my... there were a lot of people making claims that this business has great operating leverage, just a few more sales dollars, and so much drops to the bottom line. I ever tell you about my disaster in that category? I think I did. It was a trade show company. Yeah. So basically, I would just say operating leverage. Financial leverage, they say, works both ways. Operating leverage works both ways too. And if you're in a business that is closer to peak in earnings and you're adding growth to that, and you have operating leverage, it gets kind of scary. So even though it's a good thing, sometimes it's a bad thing, and you really have to know where you are. And there's actually more risk sometimes in those. I learned that the hard way, so I'm never going to forget that again. I got to look at that a few times. I figured save you a few bucks along the way. Also, here's another thing that's important. Stock's at 5. You figure it's worth 10. Who thinks that's a pretty good margin of safety? Okay. It usually is, except let's say there's $40 a share in debt on the company, right? So now you're talking about an EV of 45 going up to 50. And so your margin of safety on your valuation work isn't so great anymore. So I saw that a couple times, and it's easy to fall into that trap. It doesn't happen all that often, but when it does, it really hurts really badly. So just saying that this is, in the pitch, I would not necessarily, if there's debt on the company, I think the answer is obvious. I don't want to see in the pitch, oh, it's worth 10 and it's trading at 5 if there's a lot of debt. I'd want to see this too, and this is a lot less margin of safety. And although when it comes in handy, it'll really come in handy. So I just point that out. Take a look at that too. A lot of things you can see, especially with spin-offs and things of that nature where they load on a lot of debt, or other companies that are very leveraged, even finance companies sometimes are very leveraged. You might not have as much margin of safety as you thought. And that's one way to take a look. Oh, here's something interesting. I'm not an expert in foreign stocks. I'll just throw one more thing at you. This is the School of Hard Knocks too. Someone wrote up a very good piece on a Mexican TV broadcaster. Okay? Now, I thought one thing that they left out in the analysis, and I thought it was a great analysis, was the fact that all their revenues are in pesos. And, you know, because it's advertising revenues on the TV station. And there's some currency risk there, I'm guessing. I mean, it could be a good thing or it could be a bad thing, but you're taking a lot of currency risk in that. But because the sales are mostly in pesos. Now, if you have a foreign company, let's say I was looking at one set, and I don't remember how to spell it, but Embraer is an airplane manufacturer in Brazil. And at first blush, when I first looked at it years ago, I said, gee, that doesn't sound very good. They make a lot of the regional jets that you see. But all their sales are in dollars. Okay, so even though it's made in Brazil, so if Brazil were to be devalued or something, so their labor would be cheaper. But most of the components are bought elsewhere in dollars, and but their sales are in dollars. So they're not selling to the domestic market, and they're not collecting whatever currency there is in Brazil. Does anyone know? Yeah. Does everyone know? That's what my question is. Okay. So there's a difference here between these two businesses, and so this I thought was left out. This was left out of this one, and I just noticed that here, and I've made that mistake of either missing things because I was worried, oh, it's a foreign company. I don't, you know, I'm worried about currency risk, and where I don't worry quite as much. There are currency issues with a Brazilian manufacturer, but they're different because their revenues are in U.S. dollars. Yeah.
Doesn't the currency risk normally come in when you have the inputs in dollars? In that case, for example, inputs in dollars and the revenues in pesos, isn't that's when you...
Well, that would be even worse. But here, this is pesos and pesos, right?
Right.
So, yeah, but then if I own stock in something where their business just is worth less, in other words, you know, the business is still worth 1,000 pesos, but 1,000 pesos aren't worth, you know, they're worth half what they were last year in dollars. So that's a risk that I'm taking. That's what I meant. All right, so let me just go. Yeah, I think that's it. So I'm going to hand out your papers in a second. Linda's going to talk about retail on the 9th. I think you have enough work to do because I didn't give you much time for this next paper on the 16th. Any other questions? And for all you guys who showed up on Friday morning, thank you.
It's the same sort of format for the next paper.
Same format. I'm going to be a little tougher on it because I expect a little more. I put some comments here if you have questions on your papers. If they're very individual, send me an email or meet me before class next time. I'll be here an hour before. I always am in room 310, by the way. I'm usually lonely. You can, if it's personal, or you can ask me in class if you think it's a good question that anyone would want to know. I'd love to answer it that way.
Still
Okay.
on page 9
No one listened to me last time, so try, but it could be 2 pages, whatever, just small print, whatever you want. But what I want to see up top is really the thesis. And if the thesis could be, hey, I went through all this stuff and it's fairly priced, or I can't get comfortable and here are there are 3 reasons why, and I'll go into them, and blah, blah, blah. So let me hand out your papers. I'll just call out your name and... Oh, yes, and everyone with their name and their project, just put it on the front table when you come up.